Good morning, ladies and gentlemen. Welcome to the second day of the Macroprudential Policy Conference organized by the Bank of Lithuania. We had many interesting and insightful discussions yesterday, and I'm certain that today's agenda and discussions are going to be as interesting and challenging as the ones yesterday. Let me first invite the chairman of the board of the Bank of Lithuania, Mr. Gediminas Šimkus, to welcome you all today. And it is also my great pleasure to announce that after Mr. Šimkus' welcome remarks, Mrs. Sharon Donnery, Deputy Governor of Central Bank of Ireland, will give us a keynote speech. So, dear Governor, please, the floor is yours.
Good morning, ladies and gentlemen, and it's my pleasure to welcome you today on this second day of this fourth biannual Macroprudential Policy Conference. And I hope you all enjoy the talks and discussions yesterday, and today's agenda is exciting as yesterday's, of course. Today we will consider possible enhancements to the use of macroprudential instruments, especially those mitigating the risks arising from the low interest rate environment. And today we will share opinions on how to calibrate or augment the framework of borrower-based measures to minimize the undesirable impact of these instruments on wealth inequality. And we will discuss whether macroprudential policymakers are prepared and whether they have the necessary tools for the mitigation of climate-related risks to financial stability. Among the many distinguished speakers and participants today, I would like to express a very warm welcome to our keynote speaker, Mrs. Sharon Donnery, the Deputy Governor of the Central Bank of Ireland, and I'm looking forward to her keynote address. Lithuania and Ireland have a lot in common. We are both small EU countries with numerous and energetic diasporas abroad. Both of our countries see the potential in the fields of technology, life sciences, fintech. When faced with COVID-19 pandemic, both the Irish and Lithuanian economies experienced the smallest impacts in the EU. Ireland, in fact, was the only EU country to record a positive GDP growth in 2020, and Lithuania was among the countries that experienced one of the least negative impact on GDP. I'm eager to hear what Sharon will tell us about the role of macroprudential policy instruments in ensuring house price stability during the outbreak of the pandemic. And I also hope Sharon will shed some light on how borrower-based measures should change as we move into the later stages of the pandemic and the post-pandemic new normal. Housing price growth in Ireland, as well as here in Lithuania, has picked up in recent months, and housing affordability indicators have started to deteriorate. Yesterday, I talked about the changes the Bank of Lithuania is considering implementing in its macroprudential policy toolkit to curtail potentially speculative purchases of non-primary properties and ensure financial system resilience to the housing market perturbations. Our aim is to cool certain segments of the housing market and thus sustain housing affordability for those purchasing primary residences. I share Sharon's view that while we as policymakers should care about housing affordability, first and foremost, we should ensure that people do not take on debts that they will ultimately be unable to pay. We need to ensure that credits is not adding fuel to the housing price growth. We do not want another lending-driven price spiral. Resilience should be at the core of our approach to financial stability. In strengthening resilience, we need to learn from each other's experiences. Today's keynote speaker, Mrs. Sharon Donnery, the Deputy Governor of the Central Bank of Ireland, is an immensely experienced central banker with vast experience in matters of financial stability, including the area of macroprudential policy. She joined the Central Bank of Ireland 25 years ago, in 1996, as an economist in the Monetary Policy Division. In March 2016, Sharon was appointed Deputy Governor of the Central Bank of Ireland, the first woman to assume this role. She is responsible for leading on financial stability and economics, as well as many other directorates at the Central Bank of Ireland. She has also been the chair of the ECB Budget Committee since December 2016. I'm delighted to have you, Sharon, here today to share the Irish experience of the COVID-19 pandemic And now gladly pass the microphone to you, Sharon. The floor is yours.
Thank you very much, Governor. Good morning to you and to all of the colleagues. Ladies and gentlemen, it's a real pleasure to be here with you today to speak about, as the Governor mentioned, the very important topic of macroprudential regulation, particularly in the mortgage market. A topic that, of course, has grown hugely in importance to central banks in Europe since the global financial crisis, and one that is core to the mission of the Central Bank of Ireland. So today, as the Governor mentioned, I want to share with you our experience of using these measures to date, including during the recent pandemic stress, and talk to you a little bit about how we are now taking stock, listening to experiences, and ensuring that our framework is robust, balanced, and effective in serving the public in an evolving real estate market. Now, one of our key goals in the Central Bank of Ireland is to safeguard financial stability, essentially ensuring that the financial system can absorb rather than amplify adverse shocks, and that banks can continue to serve households and businesses through times of stress. Simply put, our approach is to meet this goal is to build resilience when times are good, so that this resilience can be drawn upon when times are bad. And the active use of macroprudential policies, including our mortgage measures, is key to meeting this goal. Now, over the last half decade or so, we've had two main pillars of our macroprudential policies: the bank capital measures and our mortgage measures. More recently, we've also increased our analysis of macroprudential policies for the non-bank sector, which is reflective of the relative size of the international industry in Ireland, as well as its increasing interconnectedness to parts of our domestic economy. On the bank capital side, just briefly, we've a number of instruments at our disposal, including the countercyclical capital buffer, the other systemically important institutions buffer, and the systemic risk buffer. Now, while our current assessment is that the macroprudential regime, both in banking and in the mortgage market, have both generated substantial resilience, which could be drawn upon during the pandemic, we nonetheless recognise that the operating environment for our macroprudential regime is constantly evolving, and at certain junctures, a deeper review of our overall frameworks is necessary. And that's why this year and into 2022, we're carrying out a framework review across the three pillars of our macroprudential policy framework. So the mortgages measures, the bank capital regime, and market-based finance or non-banks. Now, while all of these policies, of course, do interact, today I'm going to focus on our mortgage measures. We are acutely aware that the mortgage measures directly affect individuals and families in Ireland, including their decisions about potentially purchasing a home. And it's for this reason that the public interest is really at the heart of our approach. Now, the Irish mortgage measures were first introduced in February 2015. It was at a time when memories of the financial crisis were fresh in Irish minds. The effects of the crisis in Ireland were particularly severe, with the unemployment rate increasing by over 10 percentage points to peak at about 16% in late 2011, early 2012, while property prices fell by over 50% from their peak from 2007 to 2013. The financial crisis had left significant scars across all segments of the Irish economy and society. Losses on residential mortgages, following what had really been a prolonged period of unsustainable lending standards, had contributed significantly to our banking crisis, which culminated in the Financial Measures Programme of 2011 and the associated support from the International Monetary Fund, the European Central Bank and the European Commission. While unsustainable mortgage lending and the ensuing arrears crisis had direct effects on bank balance sheets and on households themselves, there were also wider effects. Many small and medium-sized enterprises had seen their balance sheets impaired after misallocated borrowing to expose themselves to the property boom. Consumption across the economy had been artificially inflated by housing wealth, and collateral effects had gone into sharp reverse. Windfall revenues, which were linked to the construction sector, had given a misleading picture of how sustainable the Irish public finances were, and negative equity was a reality for 40% of mortgaged households, restricting borrowers with a desire to move home, restricting them from switching to avail of lower interest rates, or to borrow against their collateral for consumption purposes. So the unsustainable mortgage lending and the subsequent crisis entailed large and persistent costs for society as a whole. Learning lessons from the past since their inception in 2015, our measures regulate both loan-to-income and loan-to-value ratios at mortgage origination. They've had two objectives since they were introduced in 2015, increasing the resilience of banks and borrowers to negative economic and financial shocks, and dampening the pro-cyclicality of credit and house prices, so a damaging credit house price spiral does not re-emerge. Now, evidence-based policymaking is crucial for the Central Bank of Ireland, and from their very inception, the measures have had economic research and data analysis at the heart of their design. Granular data collection had been central to our policy approach since the stress testing programme in 2011 that had accompanied the recapitalisation package of the Irish banking system. And during 2014, these data were used to provide an analytical support base for our decisions about the mortgage measures. Now, firstly, the data showed clearly that the originating loan-to-income and loan-to-value ratios had risen sharply in the years running up to the crisis, and you can see this in the chart here, and that both were associated with higher default rates during the crisis. Secondly, the data also showed us that there was a substantial difference in default rates between first-time buyers and those moving home, and these are referred to locally in Ireland as second and subsequent buyers, with this latter group, the second and subsequent buyers, much more likely to default, even when controlling for a wide range of observable factors. So, motivated by these research findings, our measures apply a loan-to-value limit of 90% for first-time buyers, with a loan-to-value limit of 80% for the second and subsequent borrowers. This approach has also been taken to address concerns regarding fairness, access to mortgage finance, and home ownership for first-time buyers. Since their introduction, the measures have undoubtedly had an effect on the Irish mortgage and housing markets. Mortgages are among the longest maturity loans on bank balance sheets, but even after just 6 years of operation of the measures, close to 40% of loans on bank balance sheets have now been issued under the measures. The measures have underpinned an improvement in credit quality. It's clearly very difficult to ascertain how borrowers and lenders would have reacted in the absence of our measures during a period that has been characterised by weak housing supply and rapid growth in housing prices, which followed, of course, as I mentioned, a more than 50% decline from 2007 to 2013. However, we can look, and this chart is an example, at the distribution of loan-to-income ratios among loans originated in recent years and in the run-up to the previous crisis for an indication. And the constraining role of the measures is clear, with a large bunching of borrowers at the loan-to-income limit of 3.5 in recent times, compared to a longer right tail of higher risk loans in previous times. Now, aside from underpinning the resilience of borrowers and lenders, the measures have also guarded against the re-emergence of a credit house price feedback loop. In the short run, this is evident both in survey data of house price expectations of market participants, which shifted downward immediately after the introduction of the measures. This indicated an understanding that previous cyclical dynamics in the housing market would be less likely with these restrictions in place. Similarly, the effects were evident in observed price data, with regions more acutely affected by the calibration of loan-to-income and loan-to-value limits experiencing disproportionate slowdowns in price growth during 2015 and 2016. Looking over the entire period since the measures have been introduced, counterfactual exercises suggest that house prices may have been up to 25% more expensive had the measures not been introduced to guard against looser lending standards. Now, the COVID-19 pandemic was the first major crisis since the introduction of the measures, macroprudential policy measures, and of course the wider reforms to the bank capital frameworks that had taken place since the global financial crisis. Borrowers were more resilient too, with originating loan-to-income and loan-to-value ratios at more modest levels than was the case during the previous periods with similar economic conditions. Now, to mitigate the threat to public health, Ireland has implemented among the most stringent public health measures in Europe, leading to shuttering of large sections of our economy. As a result, consumption fell by almost 1/5, and 1.2 million people, or close to half the Irish labour force, were reliant on the state for either welfare payments or wage subsidies by Q2 2020. Now, this direct fiscal support was supported by immediate and accommodative monetary policy actions, while a series of macroprudential and microprudential actions allowed the banking sector to absorb the shock. One of these specific actions, which resulted from extensive engagement between banks and their regulators, both in Ireland and across many other countries, of course, was the extension of payment moratoria to borrowers. And by midsummer, payment moratoria on more than €11.5 billion of debt had allowed households to postpone their mortgage repayments. This provided critical liquidity relief, which has thankfully only translated into longer-term difficulty for a very small share of the mortgage market, indicative of the success of the policy response and of the strength of the recovery. Now, research on the take-up of payment breaks in Ireland by mortgage borrowers is instructive on the role that the mortgage measures played during this period of stress. Data show that loans granted after the introduction of the measures had substantially lower levels of payment break take-up compared with those issued prior to the global financial crisis. This is likely indicative of stronger underlying borrower resilience and more prudent levels of credit assessments by banks since the crisis, and both of these have been copper-fastened by the measures. Data on the relationship between payment breaks and the underlying level of loan-to-income and loan-to-value ratios provide further supportive evidence. So take, for example, a borrower with a loan-to-income ratio of 2, who was half as likely to request a payment break compared with a borrower with a loan-to-income ratio of 4. And I would say overall that these comparisons reassure us that the measures have played a role in preserving borrower resilience in the face of this extraordinary shock. The resilience benefits are more directly visible in metrics such as default rates and payment break take-up rates. However, an equally important but maybe less obvious benefit of the mortgage measures related to the resilience of the housing market overall to adverse shocks that could have resulted from an overvaluation leading into the pandemic. As I mentioned earlier, counterfactual estimates from bank staff show that housing could have been much less affordable in March 2020 in the absence of our measures. And had we entered the pandemic with a credit-fueled overvaluation, the market would have been more vulnerable to a sharp house price correction. And this, of course, would have come with the ensuing elevated risks for borrowers and banks during the pandemic stress, and heightened risks of the banking sector acting as an amplifier of that stress. Let me now take a step back to discuss our overall framework. Every year since 2016, we have reviewed the mortgage measures against their stated objectives. In the past, the changes implemented during these reviews have included, for example, an increase in the loan-to-value limit for some first-time buyers, and changes to the size and the composition of the allowances that we permit above the limits. While we will do this again this year in 2021, we are currently also in the process of doing something significantly different in parallel, an overarching review of our entire framework around the mortgage measures. And in this framework review, we are assessing deeper, longer-term issues to ensure that our policy framework remains fit for purpose, not just for now, but also into the future. Now, at its core, this review will reflect the bank's goal of serving the public interest, with the areas we focus on determined by listening to our stakeholders, lessons learned from experiences across the globe, an assessment of key changes in the housing market and the wider economic environment since 2015, and focused evidence from our extensive analysis. The first step to inform the review is to ensure that we understand the environment in which our measures operate and that this may have changed since 2015. Research we are publishing today looks at how the housing and mortgage markets have evolved in Ireland in recent years and also assess how the Irish mortgage and housing affordability compare in a European context. Domestically, of course, much has changed in the housing market since 2015. The historical relationship between credit and house price dynamics is shifting. Indeed, it's weakening as the post-crisis increase in non-mortgaged actors in the housing market has maintained. The price elasticity of housing supply has remained very low in Ireland, perhaps beyond any of our expectations in 2014, meaning that recent price growth has simply not, up until now in any event, been accompanied by the supply type response needed to keep up with demographic demand. The cost of rents for those looking to access new tenancies has undergone significant growth, increasing affordability issues in the face of a continued imbalance between the demand and supply of housing services. And these factors provide important context for any decisions we make with respect to the measures. Now, housing affordability pressures appear to be a challenge facing a number of societies globally. Some of the research published today, for example, suggests that a number of countries have seen house prices grow faster than incomes in recent years. And while, of course, it's difficult to have a consistent comparison of the level of house prices relative to incomes across countries, the same research does suggest that estimates of house price to income ratios in Ireland have remained around the median for a selection of OECD countries during the period of the operation of the measures. This, of course, will not provide solace to an individual or a couple experiencing difficulties in attempting to purchase a home. But it does suggest the challenges being faced here are part of a wider set of global trends in housing markets. Looking across countries at the experience of individual households in the mortgage market, it's clear that the era of mortgage measures has been associated with a decrease in mortgage repayment burdens among those drawing down new mortgage finance. This in part reflects the coincidence of the era of macroprudential policies with that of low global interest rates, as mentioned by the Governor earlier. Now, this has had an influence in lowering mortgage borrowing costs across the continent. However, the particularly large reductions in repayment burdens in Ireland have also been influenced by the implementation of mortgage measures in our case. Our research, which is published today, also tries to assess housing costs across the population in the round, using a range of survey sources rather than focusing solely on house price and rental indices, which measure new transaction activity only. This research suggests that loan-to-income ratios across the mortgaged population are similar in Ireland to elsewhere in Europe, and have fallen more than most since 2013. Looking more specifically at renters, OECD estimates suggest that the share of lower income households with particularly high rental burdens is below OECD median levels. The research released today notes that the particularly high share of households with subsidised rental costs in Ireland is likely to form part of that explanation. However, of course, this doesn't take away from the very real challenges for individuals that I mentioned, particularly for new tenants for whom rental costs have increased significantly. Aside from analysing how the Irish mortgage market has changed in recent years, a key aim of our overarching framework review is to reassess whether the objectives of our policies remain appropriate. As I've said, the current objectives are twofold. Firstly, increasing the resilience of banks and borrowers to negative economic and financial shocks, and second, dampening the pro-cyclicality of credit and house prices so a damaging credit house price spiral does not re-emerge. Collectively, these can be thought of as the benefits of the mortgage measures. Research published today by my colleagues, along with Professor David Aikman of King's College London, considers the range of benefits that accrue to an economy when such measures are in place. In looking across the research literature in this area, one way to describe the benefits of such policies is that they accrue to all citizens rather than new mortgage borrowers only, operating through the reduction of both the likelihood as well as the severity of a recession stemming from spiralling house credit dynamics. Macroprudential mortgage policies achieve these benefits through a range of channels. They restrain the effective demand for owner-occupied housing by limiting the contribution of mortgage finance to growth in house purchases relative to incomes. They also limit the role that exuberant expectations can have in amplifying house price growth with a number of knock-on benefits, for example, in lowering the risk of unsustainable growth in borrowing backed by property to fund consumption. And our own experience in Ireland up to 2008 shows clearly that housing booms infiltrate the entire economy when they become unsustainable, influencing the labour market, consumption, government spending and tax policy, as well as the obvious bank lending, borrower indebtedness and housing overvaluation channels. Now, our research with Professor Aikman also highlights the range of potential costs that macroprudential policies can impose on the economy, which in many cases are experienced more directly and immediately by the population. These macroeconomic costs can include reduced activity in the housing market, reduced capacity to borrow financed by home equity, reduced housing-related consumption of items such as white goods, and potentially reduced housing supply. The literature is only beginning to emerge on some of these more immediate costs. However, there's also potential for broader, more difficult to measure long-run costs that we must consider, such as the impact of housing equity on life cycle consumption and the cost of housing servicing costs into retirement in the event that longer-term home ownership rates remain lower than was previously the case. Overall, while there are potential downsides to macroprudential mortgage policies, our view is that the benefits heavily outweigh the costs. The benefits may at times not be as visible as the direct effects on individuals or households. But as we saw recently in a time of great crisis, the resilience built for both borrowers and lenders through the measures was crucial to avoiding the financial stresses and economic hardships that could have emerged. In addition, for supply-constrained housing markets, it is important to remember that there are many other policy levers that can be used to influence housing construction, such as planning levies, building regulations, and the tax system. As our research outlines, the economy is likely better served by a policy mix that stimulates additional housing supply through reductions in construction costs, rather than through increased price levels resulting from higher borrower indebtedness. Now, one topic I would like to discuss briefly before I conclude relates to distributional effects, or the effects that are particular to specific groups of the borrower population of macroprudential mortgage measures. Now, looking at the data on borrowers, it's clear that the market in Ireland has been changing during the era of our macroprudential mortgage policies. The age profile of borrowers has changed, with the median first-time buyer age increased from 30 to 35 since 2008. And the income profile has also changed, with the average incomes of mortgage entrants continuing to increase since 2015. Now, taking together these findings of increasing age and income among mortgage borrowers, at first glance may suggest the measures have played a role in limiting access to the market among younger, lower income borrowers. However, I think it's important that these findings are set in a wider context. Firstly, the Irish population at large is ageing, and a range of societal and economic trends have been contributing to the rising age of mortgage market participants. Secondly, incomes at large have been rising during the economic recovery, as evidenced by similar growth rates among new first-time borrowers and the population under 50 since 2015. Thirdly, there has been a continual and, in a cumulative sense, expanding gap between demand and supply in the housing market. This has exerted continued upward pressure on house prices and has caused an increase in the number of borrowers, especially at lower incomes, who are bound by the mortgage measures. While a loosening of the mortgage borrowing limits may seem attractive as a way to address such distributional outcomes by improving access to the mortgage market among those most constrained, there is much uncertainty about how this would work in practice. In a supply-constrained market, the increased purchasing power of all borrowers could result in similar levels of access to the mortgage market, coupled with higher levels of prices, and as a result, more highly indebted households. Simply put, more money chasing the same number of homes, resulting in higher debt for households and individuals. As things stand, there are two features of our framework that address issues related to borrowing by specific groups. Firstly, the difference in the loan-to-value limit on first-time buyers relative to second and subsequent buyers acknowledges both that the evidence suggests that first-time buyers are lower risk, but also that accumulation of down payments can be more challenging for this group, for whom access to a mortgage implies access to home ownership. Secondly, the existence of the allowances for lending above each macroprudential limit allows flexibility and the consideration of the circumstances of individual borrowers. This means that the allowances act as a separate channel through which the effects on certain borrower groups can be considered. Of course, lenders make their own commercial decisions on the borrowers that receive these allowances, but our research up until now suggests that the borrower groups that are constrained by the measures do indeed receive the allowances. However, the data also suggests that higher value properties are more likely to receive an allowance, with this effect driven by the predominance of borrowers in urban centres among those accessing the allowances. Taken in the round, the evidence base suggests that the allowances play a role with respect to the distributional consequences of macroprudential policy, but they cannot be a substitute for government policy to address wider issues in the housing market. So, I've outlined a wide but not exhaustive list of the issues currently being considered by the Central Bank as part of our overall framework review. Our regular annual review will conclude as normal later this year, while into 2022 we will continue to work to ensure our strategy and toolkit remain fit for purpose in view of the evolution of our financial system and the economy. A challenge for macroprudential policymakers is to continue to make the case that the benefits of our policies justify the existence of our measures. These benefits are, of course, invisible to citizens day to day, as they relate to the mitigation of risks relating to economic recessions and financial crises. This is a challenge the Central Bank has worked hard to meet, regularly explaining the decisions we've taken and sharing the evidence we consider through publishing our research and analysis. And we will continue this approach in communicating the outcome of our framework review next year. As the Central Bank of Ireland has said on numerous occasions, these measures are a permanent feature of the Irish mortgage market. They play a key role in increasing the resilience of banks and borrowers to negative economic and financial shocks and dampening the procyclicality of credit and house prices, so a damaging credit house price spiral does not re-emerge. We've recently seen the policies contribute to meeting their objectives as the resilience built up since the introduction of the mortgage measures showed its worth during the pandemic. The Central Bank of Ireland's mission is to serve the public interest by maintaining monetary and financial stability while ensuring that the financial system operates in the best interests of consumers and the wider economy. And our mission will continue to guide our decisions as we conclude our regular annual review this year and as we conduct our wider framework review over the next year or so. Many thanks again for the invitation and for your attention, and I look forward to the discussion and our questions.
I would like to thank Mr. Šimkus for the welcome remarks, and also I would like to express a huge gratefulness for your speech, Mrs. Donry. Let us now move to the third session of this conference, which will be discussing the potential of the borrower-based measures and possibilities for enhancing the framework. And before opening this panel, I would like to remind our viewers that you are able to ask questions in the comment box that can be found just below the video translation. And also, if you like, the question that has been already asked by another viewer, you can press the like button and this comment or question will appear up front. Let me now introduce the first speaker of this panel, which is Mr. Francesco Mazzaferro, head of the ESRB Secretariat. And Mr. Mazzaferro's interesting international career started in 1992 when he joined the European Commission, where his work focused on the preparations for the introduction of the single currency. In 1995, Mr. Mazzaferro joined the European Monetary Institute, which later became the European Central Bank. In 1998, Mr. Mazzaferro worked in the European Relations Division and then led the EU Neighbouring Regions Division. So it is my great pleasure to introduce Mr. Mazzaferro and to give him the floor. Francesco, please, the floor is yours.
Thank you very much, Agnes. Thank you very much to the Bank of Lithuania, also for having been able with its own fantastic technicians to solve a technical problem at our end. And the price to pay is that unfortunately I will not be able to move the slides myself, so I will please ask somebody in Vilnius to do it for me. My task today is to try to focus on the adjective untapped, which is an important part of our title. So what are the things which do not exist yet? What is the potential which exists with our instrument? So I will not very much focus on experiences and try to draw balance of what we already know, also because several speakers yesterday have been done in a more authoritative way than I might do. I will think about new things, and I will also try to take a broad picture. First of all, in the sense that I think we should speak not only of households, but also of small and medium enterprise and non-financial corporations. And also that we should not focus only on residential real estate, but certainly include commercial real estate and probably also going beyond it. Preparing this presentation, I was discussing with some colleagues that maybe in some years the collateral which will be used for lending will not be any more houses, but it could be cryptocurrencies or things which look very mysterious to us. So we have to be ready. We have to be ready to a world which is going to change. If then we can go to the second slide, please. Thank you. Well, the picture shows that construction, the buildings, and also, so to speak, the ways in which our towns look like is very different. And so it's not surprising that we have also an extreme variety of legal frameworks in the European Union. We have them in terms of instruments. Also yesterday, everybody was referring to the LTVs, the DTI, the STI. We have also different terms of prescriptiveness. Some of them are based on law. Some are based more on contractual rules. We have difference in terms of governance. Who is going to decide on their use? Before deciding on then who is going to make the risk assessment and who is going to implement the decision activating the instruments. The coverage, and I already referred to it, may be different. In some cases, it's simply households for real estate, for residential real estate. In other cases, it's much larger. We refer to it also later on. And also the flexibility is to a certain extent diverse. The degree of preventiveness, in some cases, this preventiveness is limited in the sense that there must be the materialization of some risks in order to be able to activate the measures. In other cases, it's the simple identification of the risk is sufficient to move. And of course, the design. So we know that LTVs may make difference between the first buyers, identify a specific situation of risk of over-indebtment, and so on. And of course, the calibration. You know, there are even countries in the European Union where the LTV is above 100%, which of course is to a certain extent extremely surprising. Now, in this situation in which we have a super variety of tools, we need to have a criterion, and if possible, a single criterion to assess these instruments. And I think we should be pragmatic, and at the very end, what counts is whether they are effective and efficient. And in some cases, they are not as effective and as efficient as we would like to have them. And this is the reason why on the top of these borrower-based measures, there might be also other soft measures which can provide additional flexibility to both policy makers and credit providers. So this is something which is to a certain extent in the realm of, so to speak, of the fantasy of the broad openness of judgment of authorities. Now, of course, compliance with these measures is to a certain extent not completely ensured, and therefore, perhaps the only way to ensure that it would be possible to pursue the goal in an effective way is to broaden the legal system and to have legally binding measures also in a broad sense. Now, if we can go to the second slide, please. We are also, of course, aware, and could not be differently, that all this discussion which we are having is also the consequence of the low yield environment in which we are. And by the way, the SRB has been recently renewing its own analysis of this issue, coming to the conclusion that, in our view, we will remain in the low level of interest rate framework. This has created also in our world of borrower-based measures some new developments. The first one is that it's not only households which are investing. We have more and more institutional investors which want to enter also in the residential real estate domain. Also because they are aware that the commercial real estate in which they were dominating is becoming a risky business. The implications of this is that borrower-based measures which would target only households might become limited in terms of their effectiveness. Because at the very end, what we would have is measures which might deteriorate and impact on the ability of households to purchase property, but at the same time would not be able to to hit the real issues. So there might be economic repercussions for consumptions and economic growth, but less efficiency from the point of view of the measures. This is the reason why we think that borrower-based measures should be available to all types of borrowers, lenders, and types of credits. We have, by the way, in a number of countries, a limited number of countries, and I would like to mention Spain, I would like to mention Ireland. We have heard, of course, from Deputy Governor, Sweden, also Denmark, situations in which the framework is already very broad. And this has been happening also because the legal basis at the national level has been establishing exactly an equal treatment among the different forms of subjects which were involved in the application of the tools. And we had very large and broad-based definitions of the instruments, in particular, also in the sense of having, so to speak, equal. I mean, a situation in which we have been trying, and this is something, sorry, which have been also trying to do it in the SRB ourselves with the recommendation on closing real estate data gaps. So what we would be needed is an attempt to reduce the room for circumventions of the measures, having all type of loans, so from all credit providers included in the implementation. Let's now go to the following slides, please. Beyond the issue of the field and the scope of application of the measures, what is also important is to have a good analytical understanding of what are the underlying economic conditions. And I think it should be absolutely important from this point of view to ensure that effectiveness and efficiency of the measures are supported by sufficient analytical tools. Yesterday, for instance, already some of our colleagues from Slovakia have been referring, for instance, to one paper which is mentioned here in the slides. There has been also studies which are also mentioned here in the slides by the Bank of England. What we need is are rigorous approaches which are able, by the way, to increase also the time profile and the time perspective of the analysis. It's very interesting, but also very worrisome to see that for contracts which very often have durations of 20, 30 years, and in any case are not short-term, the analysis of risk is very often limited to 3, 4 years in terms of projections. And what is also and what we are trying to do, and of course is limited, is to reason how to move this profile from the 2-3 years, which are normally the time profile of stress testing, to maximum 5 years. If we were able, by the way, to create a situation in which the analysis is more credible, this would also not only ease our accountability, but in the best of the possible world, perhaps dreaming about it, we could even have more self-regulation, because people would be more convinced that the measures which are taken are based on a very good understanding of reality, and they might, so to speak, also follow them, going beyond what is legally required. One of the issues which we have with stress tests, by the way, is the fact that stress tests are mainly linked to the past. So they are based on the past lending standards, while what we need are more parametric scenarios which are looking at behavior in the future. So what we would need are more alternative exercises from the side of our economists, which would try to basically understand what are the implications of the current lending standards for the future. By the way, they should also be based on the fact that already in the time when the economy is going well, and so not only in the moment of deterioration of the economy, there might be a serious accumulation of risk, which should be modeled. If I may go now to the next slide. There is obviously also a very large domain for action from non-macroprudential authorities. We are absolutely aware that many of the structural issues which are with us are linked to taxation problem, incentives, which in some cases exist since decades, the structure of the rental market, which in some situation is so inefficient that it creates additional pressure on property markets, and also possibly the insufficiency of new constructions. In a number of countries, these are issues which are on the front page of newspapers. Obviously, these are issues on which we do not have control. What we can do is issue warnings. We can issue recommendations. The SRB has been doing it in 2016 into 2019. We are now currently being ready for a new wave of actions. But of course, we are also aware that there is political sensitivity and that there are distortions which are being created in the economy. At the same time, we are also aware that changes in the legislation, structural reform in this case, should be very carefully considered in terms of timing, because we want, of course, to avoid the procyclical effect. We do not want to have materialization of risks. I'm now turning to the last slide, which is a bit a plea for coordination among all the authorities. We have been speaking of diverse situations which are, so to speak, also intentional, very broad. We are speaking of lending to households, small and medium-sized enterprises, non-financial corporations, all type of risk, all type of loans. This, of course, very often is going beyond the field and scope of what can be done by a single institution, both at European and national level. So it's very important that there is a very strong communication among all those who are involved at the public side, and there is an exchange of information and also readiness to contribute to mitigating the sources of risks. Thank you very much, and thank you also to those who have been moving the slides for me. Thank you.
Dear Francesco, thank you very much for your very interesting presentation, as always. Let me now introduce the second speaker, the second panelist, Mr. Rolf Jacob. Mr. Jacob joined the European Commission in 1989 and since 2019 has been leading the unit in charge of macroprudential policy within DG FISMA. This unit is the Commission's main interface with European and global bodies in charge of financial stability and monitors the correct application of macroprudential policy instruments within the EU legislation. Previously, Mr. Jacob was in charge of the unit dealing with retail financial services and payments, developing in particular the regulatory framework for open banking and innovations in payment services. It is my great pleasure to introduce Mr. Jacob and to give him the floor. Mr. Jacob, please.
Thank you very much for your kind words of introduction, and a big thank you to the Bank of Lithuania for organizing this conference on a very topical subject. The focus of my presentation will be on a possible EU framework for borrower-based measures, after Francesco focused more on the untapped potentials, but I think I will be saying a few things about these issues as well. From the Commission's perspective, this conference is very timely because we are going to launch two major legislative reviews that will be very relevant for the use of borrower-based measures in the EU. One of these reviews concerns the Mortgage Credit Directive of 2014. This is a piece of legislation which had already been envisaged before the global financial crisis to remove barriers to the internal market for mortgage credit. The crisis, however, highlighted the importance for financial stability of preventing irresponsible lending and borrowing, including through foreign currency loans, which used to be an issue in some member states some years ago, and which luckily has become much less prevalent and risky. The other review, which is coming up, concerns the macroprudential rules contained in our prudential regulation or legislation for the banking sector. This concerns the Capital Requirements Directive and regulation. I don't think I need to give any further introduction to these pieces of legislation, which will be very familiar to our listeners. Now, this conference is also timely in view of what is currently happening in residential real estate markets and household debt levels. The prolonged low interest rate environment had already contributed to rising house prices and debt levels before the pandemic. And while the pandemic had a negative impact on many parts of the commercial real estate market, it may actually have boosted demand for residential property, as was also mentioned by some speakers yesterday. These challenges are immediate and will test the current framework for borrower-based measures. Sorry, I forgot to move on with the slides. So these are the references to the upcoming legislative reviews. I guess the slides will be available to the audience and participants in this event later on. Now, the current framework of borrower-based measures is actually a patchwork of national frameworks. We don't really have much of an EU framework. Borrower-based measures are not defined or framed in any way in the legislation on capital requirements, and in a way that makes sense because borrower-based measures are not capital-based. They are, however, regarded as important elements of the macroprudential toolkit. This was recognized by the ESRB recommendation of 2013 on intermediate objectives and instruments for macroprudential policy, and they are further specified in the ESRB handbook on operationalizing macroprudential policy in the banking sector. Borrower-based measures applied to households are quite similar to creditworthiness assessments. This was also pointed out yesterday by at least one speaker. Borrower-based measures are taken from a macroprudential perspective, while creditworthiness assessment tends to be more about consumer protection, but it is of course also highly relevant and important for financial stability. The Mortgage Credit Directive mandates creditworthiness assessment, but also specifies that this should rely not only or even predominantly on loan-to-value ratios. And of course, creditworthiness should not be based on the assumption of rising property values. Creditworthiness assessment should consider all factors that determine a consumer's ability to meet the obligations under a credit agreement that specifies this directive. And that requires, of course, a lot of information. The Mortgage Credit Directive does not specify what information should be collected and provided by whom, but it does require non-discriminatory access to credit databases for creditors from all member states. So there is the internal market logic of the directive. The rules in the Mortgage Credit Directive are very general, but there is some more specific guidance available from the European Banking Authority, both on how to assess a consumer's creditworthiness and on the valuation of property. The EBA guidelines on loan origination apply since the end of June this year. And Francesco mentioned the need for longer-term stress testing. The guidelines of the EBA contain a reference to the need for sensitivity analysis. So it is necessary to check how sensitive a particular loan arrangement would be to adverse events during the loan duration. Let me move on to the next slide. while we have at best a very minimalist framework at the EU level that could be relevant for borrower-based measures, we can also see that borrower-based measures are very widely used and quite effective, as we heard yesterday from Erland Nier of the IMF. The chart on this slide shows how many countries foresee various types of borrower-based measures in their legal framework, although they would not all be legally binding on banks in all the countries covered. This chart shows the availability of borrower-based measures, but I can also tell you that they are widely used. The vast majority of member states have activated soft or hard law borrower-based measures. And more often, they are legally binding measures rather than recommendations. In fact, borrower-based measures seem to be more widely used than the macroprudential tools that are explicitly foreseen in the EU legal framework as laid down in the capital requirements regulation and directive, and which could be used to address asset formation, asset bubbles in real estate markets. The measures in the capital requirements directive and regulation are, of course, capital-based, and not all of them are targeted very directly at real estate risks and vulnerabilities. So we have, for instance, the counter-cyclical capital buffer. This had been in place in about 10 countries before the pandemic, and during the pandemic, it was released by most countries. And at the end of last year, only 5 countries still had a positive CCYB. Another tool that can be used is the systemic risk buffer, which now can be targeted more precisely at specific sectors of the lending market. And at the end of 2020, we had 11 countries with a systemic risk buffer in place. But to my knowledge, none of them were sectoral and targeted specifically at residential real estate exposures. There are a number of countries which are concerned about low risk weights for real estate exposures. The capital requirements regulation allows for corrections to this directly of the risk weights used under the standardized approach. Here we have Article 124, which allows for higher risk weights to be set for this under the standardized approach. And this article has been used at the end of last year by 6 countries. But many banks, much of the bank lending, mortgage lending comes from banks with internal models. And here risk weights can also be directly adjusted under Article 458 of the Capital Requirements Regulation. And a few countries have indeed introduced risk weight floors or risk weight add-ons on the basis of that article. And only one country uses the possibility of adjusting risk weights in internal models indirectly by raising the loss given default assumption in accordance with Article 164. So these are the instruments, but as I said, member states rely a lot more on borrower-based measures than on capital-based measures. Now, for those capital-based measures, we have an EU framework. It may be useful to recall briefly what this framework does. First, it requires member states to have certain instruments at their disposal, the exception being the systemic risk buffer, which is not a mandatory requirement. The EU legal framework also requires member states to designate an authority that is responsible for the use of a particular tool. Furthermore, the EU framework specifies under which circumstances an instrument is to be used. And a very important aspect of the EU framework is to ensure that the national measures are compatible with the internal market. And this has 2 dimensions. On the one hand, the EU framework sets limits to the calibration of macroprudential instruments to prevent market fragmentation and the ring fencing of capital. On the other hand, it seeks to ensure the effectiveness of national measures through their reciprocation by other member states, so that national measures cannot be easily circumvented by turning to lenders based in another country. We have also some procedural requirements, such as prior announcements, proper justification, and regular reviews of measures, which contribute to the transparency of these measures. But all these measures. These requirements in the EU framework leave it largely to the national authorities to activate and calibrate the macroprudential measures foreseen in the framework and which could be used to address real estate vulnerabilities and risks. Can we follow the same model for a possible EU framework on borrower-based measures? Member states could indeed be required to include certain borrower-based measures in their national legislation, if that is not already the case, and to harmonize to some extent these instruments and the indicators to be used. The EU framework could also require the designation of a national authority that would be in charge of monitoring the need for borrower-based measures and for triggering their use. And it could make sense to require member states to notify their measures so that there can be some EU-level monitoring. And indeed, the ESRB has been quite active already in terms of monitoring what's happening in the real estate, residential real estate sector, addressing, as Francesco also mentioned, warnings and recommendations to a number of member states. Such a monitoring and coordination function could indeed be acknowledged in an EU framework for borrower-based measures. However, I would expect that member states will want to preserve their discretion and hence their ability to decide themselves what borrower-based measures are necessary and what borrower-based measures are appropriate also in view of the specific challenges they face, as is the case for many of the capital-based macroprudential instruments as well, which are mostly decided upon at the national level. And I would expect that there would be not much support for extending the ECB's topping up powers to borrower-based measures. As regards the internal market dimension, borrower-based measures don't pose the same problems as capital-based measures. Borrower-based measures cannot be used to restrict the allocation of capital within cross-border banking groups, a ring fencing, which we try to control to some extent. So there would not be the same need for limiting their use as we have for capital-based measures. One advantage of an EU framework could be that it would be easier to reciprocate national measures if they were harmonized to some extent and based on common definitions and indicators. However, reciprocation of borrower-based measures is not common. The first recommendation to reciprocate a national borrower-based measure was issued by the ESRB only this summer. It concerns loan-to-value limits of 80 to 100%, applicable to different categories of borrowers in Luxembourg. This recommendation acknowledges that not all reciprocating countries may have LTV limits themselves, so it invites relevant authorities to apply available measures that have the most equivalent effect. So this illustrates the potential benefits of an EU framework that would ensure that all countries have similar borrower-based measures and can easily reciprocate. It is also interesting to note that this recommendation to reciprocate should apply not only to banks, but also to insurance corporations and professionals carrying out lending activities, so mortgage lenders. That highlights a potential limitation of defining a framework for borrower-based measures in legislation that applies to credit institutions only and not to other possible lenders. An EU framework for borrower-based measures could also provide for common definitions and specify indicators to be used, how income is to be measured, how properties are to be valued, etc. Various limits could be applied, but there will always be a need for some flexibility for a fair application of borrower-based measures. The riskiness of a particular loan cannot be captured only by a few ratios, such as the loan-to-value ratio or the debt service to income ratio, and that has also been acknowledged by the Mortgage Credit Directive, as I mentioned earlier. An EU framework would have to allow for such flexibility and could specify the factors to be taken into consideration. And one of them could be also energy efficiency, for instance, and the vulnerability of the borrower to steep rises in energy costs and in particular fossil fuel prices. Such detail should certainly not be in what we call level 1 legislation, so the directive or the regulation itself. but it could be delegated in ensuring a consistent approach between creditworthiness assessment and borrower-based measures. Borrower-based measures also require good data, typically from credit registers. Some countries may need to improve these tools, but this can give rise to but if we share the data more widely, then this will, of course, also give rise to data protection issues, which need to be taken into consideration. I mentioned at the beginning of this, that this event is very timely in view of the upcoming legislative reviews. These are indeed good opportunities to consider options for an EU framework for borrower-based measures. And the review clause in the capital requirements regulation, Article 513, requires the Commission to assess whether borrower-based measures should be added to the macroprudential toolkit to allow for a harmonized use of instruments in the internal market. The Commission has to complete its review and table proposals by the end of next year. We have already addressed a call for advice to the ESRB, the EBA, and the ECB, and expect their responses by the end of March. In addition, we will soon be launching a consultation, which will be targeted at stakeholders and experts, but anyone is allowed to respond. One problem with this review is that it would focus only on banks, given that the scope of the CRD and the CRR. That's why it may also be relevant to look at the soon-to-be launched review, or the ongoing review, I should say, of the Mortgage Credit Directive. This applies to all mortgage lenders, so not just banks. But its focus is less on financial stability and more on consumer protection and internal market issues. The review of the Mortgage Credit Directive had been delayed, also due to the late transposition by member states of the directive. But a first assessment has already been published by the Commission earlier this year, but without legislative proposals at this stage. These could come next year, more or less at the same time as the proposals on CRR, CRD, again after a public consultation that will be launched very soon. The Mortgage Credit Directive does contribute to financial stability through its requirements on creditworthiness assessment, property valuation, foreign currency loans, and reasonable forbearance. But as I said, it's not the main focus. It is one of the dimensions of the this directive, which is which does not specify in great detail how these financial stability objectives are to be attained. I would also like to say a few words about a question also raised by Francesco about the scope of borrower-based measures. Do we need to look beyond CRR, CRD, and the Mortgage Credit Directive? These two legislative reviews are important opportunities to progress towards an EU framework for borrower-based measures, if we consider that this can contribute to better policies for financial stability in the EU. But the need for borrower-based measures may go well beyond households and residential real estate. The search for yield could result, as Francesco also pointed out, in professional investors becoming more active in residential real estate markets, and not just as promoters of new housing developments, but also as purchasers of existing housing stock, thereby contributing to asset bubbles. And their funding may not at all come from banks. They have access to other funding sources. The low interest rate environment also tends to favor higher leverage in the corporate sector more generally. The ESRB report on lower for longer, on the low interest rate environment and its consequences, supports the idea of a minimum common toolkit for borrower-based measures targeted at households, but also invites the Commission to look at borrower-based measures for corporates, which is a much more challenging proposition, and it calls for better credit registers. Let me conclude by saying that the discussion on an EU framework for borrower-based measures is important, but it will not help us tackle the very short-term challenges which are illustrated in this chart. And we have seen similar charts previously. We have rising residential property prices and household borrowing. And this in spite of a very sharp GDP drop caused by the pandemic. The ESRB will turn to this issue at its December meeting, and I suppose that the need for and effectiveness of borrower-based measures will be again on the agenda. But I think it will also show again, as we have seen in some recommendations issued 2 years ago, that borrower-based measures and other macroprudential measures alone may not be sufficient if other policies cause structural imbalances in housing markets. I also think that at the EU level, we may need to become faster in identifying problems and suggesting solutions, not imposing, because national policymakers will have to remain responsible for using those tools given the very different conditions in the member states. I look very much forward to the discussion in this panel, and already now invite you to watch the space where we publish our public consultations. And I look very much forward to your written submissions also in response to those consultations, or even before if you want to write to our mailbox. Many thanks for your attention.
Mr. Jacob, thank you very much for your interesting presentation. Let me now introduce the third panelist, Mr. Luís Laguinha de Souza, who is the member of the Board of Directors of Banco de Portugal. Prior to being appointed as a member of the Board of Directors, Mr. Laguinha de Souza held various managerial roles, both at Portuguese and multinational companies such as Euronext or Caixa groups. So Mr. Laguinha de Souza, it's my great honor. Please, the floor is yours.
Okay. Good morning, everyone. I would like to start by thanking the invitation from the Central Bank of Lithuania to participate in this conference. I would also like to salute my panel colleagues. The topic of this panel is very challenging, and being the last to speak, it is an additional challenge as the risk of overlapping increases. And in order to mitigate that risk, instead of addressing the topic on just a more pure conceptual basis, I'll try to address it based on the experience we've been having at the Portuguese Central Bank with the borrower-based measure we've implemented in 2018. And to do so, I have organized my presentation around 3 main points. Next slide, please. In the first point, I will try to describe in a nutshell the main characteristics of the Portuguese BBM. And to do so, I will touch upon the context in which the BBM was implemented, the main goals we wanted to achieve, and the key features that it included. In the second point, I will focus a little bit more on the strength and the limits of the BBM. And again, I'll do that based on our experience, as this will allow, among other things, to address the results we've achieved, including the outcome of an interesting counterfactual exercise. In the third and last point, I will share some thoughts related to the discussion of whether or not we should harmonize the borrower-based measures across the EU. Hopefully, we will still have time to go through Q&A after that. I've also assumed that this session is not purely technical, and this assumption allows me to use some expressions and concepts that might not completely fall in the category of technical purity, and I hope I will not be misunderstood by doing so. So having in mind what I've just said, let me jump to the first point, which is to provide a brief overview of the Portuguese borrower-based measure and the experience we've had so far. Next slide, please. The Portuguese Central Bank applied a borrower-based measure to new mortgage and consumer loans from 1st July 2018. The context in which this decision was shaped and was taken, it had plenty of ingredients that could be put on the list, but there are 3 of them that deserve being mentioned. At the time, we were observing that credit standards applied by credit institutions, they were becoming less restrictive. And that trend was expected to intensify. In spite of the strong adjustment that followed the sovereign debt crisis, the Portuguese households still showed high levels of indebtedness and a low savings rate. And we were concerned with the possibility of the adjustment being put on hold at a moment where it still needed to continue. Also, the vivid memory of the previous financial crisis, it provided two very important supports. One support was an incentive for authorities to take action, and the other incentive was also what I could describe as a positive attitude from different stakeholders. All this became a reason of concern within the central bank, both at the Financial Stability Department level as well at the board level. And it was, I could say, rapidly translated into a call to action. When we defined the goals of the BBM, we made it very clear at the time, and still do from time to time, that the purpose of the recommendation is not to reduce the credit provided by banks. What the Portuguese Central Bank aimed was preventing excessive risk-taking by the financial sector, which is different from saying that credit must be reduced. The measure is aimed at promoting the adoption of prudent credit standards on loans which are granted to households by the Portuguese financial system. And with this increased prudence on credit standards, we aimed at enhancing both the resilience of the financial sector and also the sustainability of households' financing, and hopefully by doing so, minimizing the defaults. Concerning the key features, the measure compromises the simultaneity of limits to three parameters, which are the loan-to-value ratio, the debt-to-service income, and the maturity of the loan, and also it requires regular payment of principal interest. So this degree of comprehensiveness of the measure, combined with the simultaneous implementation of several limits, it helps to reinforce its effectiveness. We know that LTV limits, they tend to become less restrictive in a context of rising housing prices, which is why they are combined with the STI limits, which in turn are combined with limits to maturity. The limits to the STI act as automatic stabilizers, and the limit to maturity prevents the circumvention of limits to the STI. The macroprudential measure took the legal form of a recommendation following the comply or explain principle. And this feature has not put at stake the compliance by financial institutions with the limits that were envisaged by this recommendation. The financial system participants, they have broadly agreed on the benefits of these borrower-based measures, particularly to financial stability, not to mention that they also saw it as a way to avoid what could be described as a race to the bottom. So this option for a non-binding legal instrument was also the result of taking into account the need to gather experience with the implementation of the measure, particularly to ensure a good understanding of the potential impact coming from a measure that was both innovative and complex at the time it was implemented. The measure is applicable to new mortgage and consumer loans and to whole credit institutions and financial companies which have their head office or branches in the Portuguese territory and that are authorized to grant this type of credit in Portugal. So by covering this full spectrum of entities and both mortgages and consumer loans, we wanted to prevent potential regulatory arbitrage. And right from the beginning, that's another important key feature. The design of the macroprudential recommendation included elements of flexibility which could be used in a stress situation. And again, here, our previous experience with the financial crisis was extremely valuable. I won't be exhaustive, but I'll just highlight a few of those flexibility elements. For instance, some credit agreements are excluded from the scope of the recommendation in order either to give greater flexibility to the design of credit agreements or to safeguard consumers against potential temporary liquidity shortages. In addition, and it has another element of flexibility, 5% of new credit could be granted to borrowers with a DSTI ratio without limit. So apart from the flexibility elements that existed right from the beginning, the Portuguese Central Bank also decided to take additional temporary flexibility measures in the context of the COVID-19 pandemic. That was the case of personal credit with maturities up to 2 years, as long as it was duly identified as intended to mitigate households' temporary liquidity shortage situation. Should personal credit fill this criteria, it would be exempted for having to comply with the DSTI ratio limit and also from observing the recommendation of regular principal and interest payments. This just stood in force from April 1st until April 30th, 2020. So based on the experience we've had so far with the COVID-19, we feel very confident in saying that it is essential to include in the design of the borrower-based measure this flexibility elements that can be used in a stress scenario and temporary exemptions to ensure that in these stress scenarios, households have liquidity in the very short term. But all this has to be done in such a way that allows continue to anchor the credit standards at prudent levels. One last feature I would like to talk about is the monitoring component. The Portuguese Central Bank has been monitoring the implementation of this recommendation since July 2018. And for such monitoring, there were different components involved, which I will just mention two. One very important component were the bilateral meetings with several institutions, among the more than 200 covered by the recommendation. We focused our bilateral meeting efforts in a group of 13 institutions, which represent a market share of approximately 95%. And the purpose of these bilateral meetings, which I have to say, they could be very tough when they occurred. The purpose was to get a sense of how banks were implementing or adopting the recommendation in the different channels they use to conduct their businesses, be it branches, digital channels through the internet. Also to assess whether the institutions, when they were planning their advertising campaigns, if such advertising campaigns were in line with the recommendation, and also to try to detect at an early stage potential problems in collecting all the data that was required for the monitoring process of the recommendation. The second very important component was the request of an annual self-assessment report on the implementation of the recommendation. This report addresses the degree of compliance with the recommendation with regard to each of the limits that are included, be it the LTV, the STI, the maturity, and the regular payments. And also, very important, combined with this, was that the report has to be approved by each institution's executive board to avoid what sometimes is called as the not aware of that syndrome, to put it that way. So let me now move to the second point I would like to cover in my presentation. Here, I would like to focus on the main results we've obtained so far. And to illustrate the results, I've chosen a few graphs which will be presented in the following slides. Next slide, please. These first two graphs show how the distribution of the new loans for house purchase has evolved, considering the LTV ratio in the first one and the borrower's risk profile in the second one. What we can see clearly through the graph on the left is that in my left, is that in 2020, almost all new credit for house purchase had an LTV lower than the 90% limit. And the amount of new credit agreements with an LTV above 100% is close to zero. That is in very strong contrast with the situation existing before the implementation of the measure, where there was a significant share of loans for house purchase with a LTV above 90%. If we consider the combination of the DSTI and the LTV ratios, which is represented through the graph on the right, we can also clearly see a continuous improvement of the risk profile of borrowers since the recommendation came into force. This improvement translates into the decrease of the percentage of new loans for house purchase, which are granted to high risk borrowers. Next slide, please. These two additional graphs, they show us the distribution of the effective DSTI ratio for new loans to households, both in terms of total new loans and in terms of total new loans, hence specifically for house purchase. It is important to mention that the effective DSTI calculation excludes interest rate shocks and also excludes income reduction shocks. In addition, the calculation of the effective DSTI is based on net income, which makes this indicator not fully comparable with the DSTI that is used in BBM implemented by other countries, as they tend to use the gross income instead. Through the graph on the left, we see that the average DSTI ratio for total new loans to households declined almost 3 percentage points, that is from 28.2% to 25.3% between the second half of 2018 and 2020. We can also see that 75% of total new loans to households had a DSTI ratio below 32% in 2020, coming from 35.6% in the second half of 2018. Through the graph on the right, we see that the average DSTI ratio for house purchase declined almost 2 percentage points from 25.7 to 23.8 during the same period. And here too, we can see that 75% of total new loans to households for house purchase had a DSTI below 30%, which compares with 32% in the second half of 2018. These results are very encouraging, and they allow us to think that BBM, the borrower-based measure we've implemented, is doing its job. But in macroprudential policy area, we are constantly dealing with this challenge of the counterfactual, which is more difficult, even sometimes I would say possible to obtain. Next slide, please. So to this respect, it is always very gratifying when, even if with certain limitations, but there are ways to demonstrate how important macroprudential measures can be, particularly if compared with a situation where such measures would not exist. And it is particularly fortunate that such demonstration can be identified in one of the first studies that assessed the impact of a borrower-based measure in the COVID-19 context. Neubauer et al. In 2021, they developed a study in which the authors find that the Portuguese borrower-based measure led to, on one side, a reduction in households' loss rate caused by a decrease in households' probability of default and loss given default. And it also led to an increase in the capital ratio of the banking system compared with a scenario where the measure would not be in place. So having in mind that the resilience of borrowers is especially important in challenging economic environments, such as those which are characterized by high uncertainty, as it was the case of the pandemic we've been going through, I believe it is fair to say that the balance between the benefits and limitations of these type of measures is clearly in favor of its benefits, especially if taking into account what is the ultimate objective, which is financial stability. Let me now move to the last point I would like to address in the discussion about BBM strength and limits. I will briefly touch upon the borrower-based measure capability to mitigate risks from low interest rate environment. And again, here I will share my views, having in mind the Portuguese experience. Next slide, please. The low interest rates, they create incentives for greater competition among banks, which of course may lead to the easing of credit standards. And as you might remember from what I said at the beginning, the concern about the easing of the credit standards was precisely one of the reasons why we implemented a borrower-based measure. But the low interest rate environment also poses another problem, which could also come from the laws of physics and not just from the laws of the economy. The problem is the likelihood of future interest rate rises and the implications that this might have, namely by generating an increase in debt servicing costs, which may become too high and compromise the ability of the debtors to make their debt repayments, which could ultimately lead to the possibility of increasing their default. And that is even more likely for those who are already more indebted or have a lower income. For such a situation, when we are in a low interest environment, potential increases in interest rates should also be taken into account in the calculation of the SDI ratio. And in the case of the borrower-based measure that was implemented by the Portuguese Central Bank, that is exactly what we did. We included the criteria for assessing the impact on consumer creditworthiness of a rise in the reference interest rate, which is applicable to credit agreements, which have variable or mixed interest rates as an indexer. So the fixed rate, of course, was excluded. The way this was put in practice is shown here on the slide. When the maturity of the contract was up to 5 years, so 1 percentage point should be applied to the index used to calculate the SDI. When the maturity of the contract was between 5 and 10 years, the index had to be increased by 2 percentage points. And for maturities over 10 years, the index had to be increased by 3 percentage points. It goes without saying that we believe it is very important to include this type of precautionary component into the BBM framework to help better understand what is the impact of this potential interest rate rises. To finish my presentation, I would like to address the last topic that was suggested to the members of this panel. And the last topic is to share a few words on whether or not there is a case for harmonizing borrower-based measures across the EU. Next slide, please. When I was thinking about how to address this topic, two things came to my mind. One of those things was the expression that you see on the slide, retail is detail. This expression, retail is detail, exists for a long time, and it exists for a reason. And it clearly applies to retail banking activities. Probably there is no area that is more detail-driven than the ones where we have to deal with each individual person, with each individual customer. And BBM qualify to be considered one of such areas, as it directly touches the lives of hundreds of thousands of individuals in families, and I'm talking just about the Portuguese landscape. Of course, it goes beyond that, and we could put millions instead of hundreds of thousands. Apart from the retail is detailed expression, the other thing that came to my mind was related to physics and to the characteristics of materials in particular. And when materials have flexibility, the capacity to resist to shocks and return to their original shape is more likely to be present. When materials they have limited or no flexibility, they are more likely to break if they become subject to strong shocks. So I believe these two things I've just mentioned, they set the tone for harmonizing borrower-based measures across the EU. Rules and procedures for instruments which target borrowers, they are dependent on national regulations. These national regulations, by definition, they still vary substantially across member states. Despite borrower-based measures being currently operational in a number of the EU member states, when it comes to their respective design and implementation, it differs substantially across member states. The SRB clearly has a very important coordination role in assessing measures, in discussing cross-border effects, and also in recommending mitigating actions, including reciprocity. And of course, this opens space for pursuing some harmonization, but such harmonization should be kept at a minimum to ensure that the balance between harmonization and flexibility is not broken. And I think we have to especially keep in mind that when we consider the particular case of the euro area, the macroprudential policy was implemented in a way that was meant to take into consideration the specificity of each country's economy. This was also considered important as a way to counterbalance the potential buildup of risks that could arise from the monetary policy, which, contrary to macroprudential policy, targets the euro area in general through a common stance that might not be totally adequate for the situation of each individual country. And so this, there has to be in place instruments that can deal with things on a more national level. And with this remark, I will stop here for now. And again, thank you once more for having invited me for the panel. And I thank Zirmantas for having passed the slides for me. Thank you.
Thank you very much, Mr. Laguinha de Souza, for your presentation. Before opening the floor for the panel discussion, I would like to remind our viewers that you are able to ask questions, and you're kindly asked to do so in the comment box that can be found just below the video translation. In addition to this, some of the viewers were inquiring whether it will be possible to receive the slides, the presentations. So indeed, those presentations will be published on the Bank of Lithuania website just after the conference. And the website is the same where you're watching the translation, is www.lb.lt. Now, I would like to present the moderator of this panel, Mr. Simonas Krėpšta, who is the board member of the Bank of Lithuania. Previously to this role, Mr. Krėpšta worked in the President's office and chaired the Economic and Social Policy Group. And prior to joining the President's office, Mr. Krėpšta was the Financial Stability Director here at the Bank of Lithuania. It's my great honor to introduce Simonas, and yeah, please, the floor is yours.
Thank you, Agne, for your great introduction, and it's my great pleasure to coordinate this policy discussion, which is very important and which might shape the future of borrower-based measures for the next decade, as we have so distinguished, policy members around the table virtually at the moment. So, reflecting the discussions we had during the conference yesterday and today, it seems that we might group, the main challenges for borrower-based measures into two or three groups. First of all, I think there is a need to have an effective toolkit of policy measures. And we saw yesterday, that some countries with a lack of toolkit face some problems in terms of the effectiveness of policy measures. And others with a considerable and reasonable toolkit have the ability to act more efficiently. Secondly, of course, we need the knowledge to use this toolkit on the structural, cyclical manner, and maybe even going beyond the household sector, which was clearly noted by Francesco. And thirdly, I think it's very important, to have the clear and effective governance and decision-making framework, having in mind that borrower-based measures, as we clearly saw from Shannon Dornery presentation, have short-term costs, and the benefits could be, seen in the longer term only. And there is challenges to measure that. And secondly, of course, the borrower-based measures interfere with the social economic policy areas, which, of course, designated ministers are responsible for these areas. And we saw fascinating examples in Denmark when these, challenges arises, and the recommendations differ considerably for actual, policy actions implemented. So I would like to start the discussion with Mrs. Tonuri, and as you representing, the institution which is among the few most experienced institutions in the macroprudential policy area in the world, if not the most experienced one. So could you please, elaborate and share your reflections on the third challenge, how to have the effective decision-making governance framework and to use the capacity as the independent macroprudential authority in implementing these policy decisions regarding borrower-based measures. So please, dear Sharon, could you share your reflections?
Thanks very much, and morning again. I hope you can hear me.
Yes.
So I think this is obviously a really critical issue. As you mentioned in your... I have some echo, I hope you don't. Are you okay?
We can hear you clearly.
Okay, perfect. So in our case, maybe just to explain in terms of the governance, the powers and decision-making is directly with the Central Bank of Ireland. So I understand, obviously, in some other countries, maybe that's not the case. There's a shared responsibility with other agencies, or potentially also the involvement of the Treasury. And in our case, it's the board of the Central Bank of Ireland that make the decision around the borrower-based measures. I suppose an important part of the governance is also about transparency and accountability, and I did touch on that a little bit in my remarks. So we are, or certainly we aim to be very clear about the basis for our decisions, how those decisions have been arrived at, and publishing, the background to our decisions, as well as a wide range of research and analytical work that has supported the decisions. We also, I suppose, have an important element around listening to stakeholders and public consultations, for example. So we do regularly engage with representatives of civic society, of consumers, of business interests, the construction sector, and obviously with the firms that we regulate as well, particularly those in this case who are engaged in mortgage lending. And like many other countries, that's no longer exclusively banks in Ireland. We do also have some non-bank lenders as well now who would be offering mortgages. So we engage with all of those in terms of, I suppose, both regular engagement and then if and when we would be making very significant changes to our framework. For example, in the case I mentioned now, where we're doing a deeper review, we would, I suppose, do even more of that sort of public engagement. So as an example, over the last number of months, we've had a survey of members of the public to gather their feedback and their views on how they believe the mortgage measures are operating. So I think these aspects about governance, transparency, accountability, they are really critical. A big challenge, of course, which has been touched on, I think, by all of the panelists, and I touched on in my own remarks as well, is that, of course, these measures don't operate in a vacuum. They do operate in the context of the wider housing market and much wider housing issues. And of course, much of the feedback that we get at the Central Bank of Ireland is actually about other issues in the housing market that can't necessarily be solved by the central bank, but where other policy levers are required, including, as I mentioned, and in fact, some of the other panelists mentioned also levers like taxation and issues to do with how the rental market operates and so on. So I think this is a particular challenge for us, because obviously we don't have a governance role or a decision-making role in relation to those issues. But we do, of course, have a role to provide general economic advice to the government and to the wider state system. And so some of our work is also focused, I think, on putting information into the public domain and explaining the parts of our decisions that can't address some of those wider aspects. So I hope that gives you a little flavour of some of the issues for us. Thank you.
Thank you, dear Sharon. It's very important, the things you mentioned, independence, transparency, and close public dialogue seems to be working very effectively and enhancing the macroprudential policy framework. And maybe some other panelists, maybe Francesco or Derhab, you could elaborate on this issue and whether we have some role on the European level to make some steps further in enhancing this governance and decision-making framework.
Thank you very much.
Yeah, sorry, Francesco.
Please, Ralph, go ahead.
Yes, I think governance issues are indeed important, and one reassuring point I would like to make is that we certainly don't want to transfer governance from the national to the European level as far as borrower-based measures are concerned, or macroprudential measures in general. I think it's important that decision-making is close to where the challenges are. The challenges differ from one country to another. But what could be important is to make sure that these effective tools are available everywhere, and that when they are being used, their effectiveness is not undermined through cross-border lending. Hence, reciprocation could become an increasingly important issue. So far, it doesn't seem to have been a major constraint. I don't remember anyone bringing this up. As I mentioned in my presentation, Luxembourg is the first country to have requested reciprocation, but I think we should keep that in mind, and that could be a good reason for making sure that borrower-based measures are available, that governance structures are available in member states. But how this is done is something which needs to be explored in much greater detail. And again, not with the aim of interfering with the possibilities of policymaking at the national level, but supporting it rather. Thank you.
Francesco, would you like to comment as well?
Yeah, thank you very much. So, to a certain extent, the example of Luxembourg is clearly linked to the fact of the geography. You know, to a certain extent, Luxembourg requires reciprocation because it is a country where basically lending can come from all the banks which are directly at their borders. And it could be considered, so to speak, as an exception. But if we are thinking about what banking could be in now from 5 to 10 years, because this is the way in which we have to think about the legislation, in the world in which there could be digitalization, in which there could be much more cross-border banking, I think that the case of Luxembourg could become more interesting. Then, of course, what is in this situation, what would be useful is also to make sure that the ways in which these measures are used would not be completely different from country to country. One of the things which is coming to my mind is that one of the instruments of macroprudential nature which has been the most successful, which is the countercyclical capital buffer, has been construed in legal terms as an instrument subject to guided discretion. So discretion means that the measures are taken at national level, but there is some guidance, by the way, to which also the SRB has been participating in terms of definitions, procedures, and this type of things. So perhaps one could also think about having a mechanism of guided guidance for borrower-based measures. So definitions should be definitions which are, so to speak, also set at European level, where you would probably in very broad terms and taking account many different scenarios, decisions would be taken at national level, but this would occur in a framework which is, so to speak, slightly more orderly than the current one. Thank you.
And I would like to give the word for Luis, of course. And you stressed during your presentation, the need of the flexibility and national specificities, relating that to physics. Could you comment on the things Francesco has mentioned? The common definitions and the guided discretion principles in using the borrower-based measures. What would be the pros and cons of such framework? So please, Luis.
Yes, yes. If you allow me, before doing that, I just would like to add something to what Sharon has said when she mentioned about what was important for the effective decision making. I'm totally in sync with what Sharon has said. I just would add to that for this transparency and accountability, and we felt that during the process of setting up our own borrower-based measure, it was very important to have our decisions based on facts. And one important element to that is being able to access, to have a central register with all the operations where you can make analysis, extract data, and confront at least the more the banking system with some conclusions that are fact-based conclusions. And against facts, it is hard to find arguments. So this is a very relevant topic. It's to being capable of demonstrate on a quantitative way the argument you are trying to make to push forward the implementation of borrower-based measures. And we had a number of occasions where we were capable of showing to banks, either on bilateral meetings or by meeting with them in broader terms, that the risks were building up and that we needed to take action. So this central register is very important. Concerning what you asked about the flexibility, I think I put it there in as clear way as possible in my presentation. Probably that is not irrelevant when we look at this ideas of harmonization. When you are at a country like Portugal that has been going through a lot of things. And we feel that it is important to have this capability of acting locally. Banking business, dealing with people is still very local on a number of things. So if you try to over-harmonize, to put things in a way that does not allow to capture this many differences that we still have across Europe, we might end up with tools that are not adequate, do not fit the purpose that they were meant to have. So that does not totally eliminate the space for harmonization, for sharing information, for see what is the commonality that can be used, particularly on data access on that area. But if you try to calibrate and to impose us too strict rules, one size fits all rules, I think it won't work. So that flexibility has to be in place. And based on the example we've had with our borrower-based measure, we believe that it was important to have the capability of defining it in a way that we felt was the most adequate way to deal with the specific challenges that we were going through in the Portuguese market.
Thank you, Luis. Of course, finding the right balance will be, of course, the key for the upcoming legislation changes and reviews. And now I would like to turn to the challenge of having the adequate toolkit of borrower-based measures. And Francesco, you mentioned in your presentation that might go even beyond the household sector. Could you, elaborate a little bit on that, and maybe you could indicate, some specific sectors, some corporate specific sectors where, there would be a need to step further and expand the use of borrower-based measures?
Well, I could make a reference to a situation which has materialized in France, where there is a situation of very high indebtedness of large corporations. This is an issue which is, so to speak, recognized, and macroprudential authorities have been signaling to it. Even the IMF has been signaling to it. But given the fact that that there is no tool which could, so to speak, be activated, the French authorities had to intervene very indirectly, and the way in which they did it was basically by issue recommendation on questions of concentration of lending. So, by the way, in this way, hitting the banks, which to a very large extent were not responsible of the issue of the leverage of the large corporations. Now, this is only an example, but I think it's a relevant one. We have to think about the fact that if at a certain time we are worried about excessive leverage, there must be tools which are able to address this in a way which is much more direct.
Thank you, Francesco. And maybe Sharon, dear Sharon, maybe you could comment on that, as you have so extensive experience, and whether you see, some leakages of policy actions going from, household sector to other sectors, and a need to, to step up with the policy applications.
Yeah, thanks for the question. Maybe two dimensions for us. So first of all, I did mention in my remarks during the crisis in Ireland, some SMEs, for example, had gotten involved in buying properties as a sort of form of investment to supplement their business. And we did also see individuals buying, for example, a second or third property to essentially be a sort of pension protection for the future. So becoming landlords in a sort of small way, but to have a second or third property. So we have addressed that particular aspect in our framework because we have requirements for buy-to-let investors as well around the deposit that they have to hold, for example, but not around the income. But a part maybe that has emerged where we do have to look at the toolkit again is the developments around non-banks. So Ireland has a fairly significant non-bank or funds industry, and it's involved in many different aspects of funds and many different aspects of finance and investment. But there are a number of funds in Ireland that are involved in property, some of those in commercial property, but some of them also in sort of developments for rental purposes. And when I mentioned briefly in my remarks, a sort of the work of the central bank to look more intently at this sector, this is part of the motivation for that. So as these investment funds are becoming more involved and particularly more directly connected to the Irish economy through their property exposures, there is obviously a risk there in terms of a build-up of risks in the property market, and also for their investors in terms of accessing that money if investors wanted to withdraw their investments. So this is one particular area that we are looking at quite closely, and it is of course part of a wider debate around macroprudential policy and the macroprudential policy toolkit for the entire non-bank sector. I think this has obviously been brought more into focus also by the pandemic because we did see for some sections of the non-bank sector sort of volatility and market disruption earlier on in the pandemic, and there is now this sort of wider debate about what tools are needed to make sure that we can address the risks that emerge in that sector and have the type of resilience, I guess, that we would want in that sector as well. So in terms of sort of further expansion of the toolkit and the things that we need, I would say that is one particular area that we are very heavily focused on. And I know, for example, that Ralph and Francesco in both the Commission and the ESRB are also looking at these areas, and we're very supportive of that work.
Thank you. That's very important. And the other area of the toolkit, effectiveness of the toolkit is whether these tools are addressed on the institutional basis or activity basis. And Ralph, you mentioned that the first step on updating the legislation is of course CRR, CRD, which is applied only on banks, and whether could elaborate what's the way forward on closing this gap, and avoiding a clear loophole in a way on this matter.
I think that's quite a challenging task. As I said, we have limitations in both these pieces of legislation that are coming under review now. CRR, CRD applying only to banks and having provisions specifically targeted at real estate exposures, nothing on borrower-based measures so far. The Mortgage Credit Directive being a bit broader in scope as far as possible lenders are concerned, but focusing only on mortgage lending, and was more of a focus on consumer protection and developing the internal market. I think we will be able to go some way towards better borrower-based measures in all member states by focusing on these two instruments. I completely adhere to the message given by Luis about the need for flexibility. We have flexibility built into the macroprudential toolkit at the European level. We need to preserve that. And we also need to have such flexibility if we move into the direction of borrower-based measures. But it will be quite a challenge to go beyond the borrower-based measures targeted at those sectors of the economy which rely mostly on bank lending, and that's households. As soon as we move to larger companies which have access to financial markets or institutional investors, it's very tricky, and we need to have a fundamental discussion about how we can deal with the risks of professional investors, for instance, also increasing leverage in the non-financial corporate sector. I don't see any easy way forward for that, but I would certainly subscribe to the view that such discussions are timely and necessary.
Thank you very much. And Francesco, it seems that you would like to add something.
Well, I wanted to also say that I completely agree with Luis on the need of preserve flexibility on everything which has to do with calibration, activation, and so on. I simply think that if we are closing our eyes and then try to see how legislation should evolve for the next decade, we should also not forget that here we are having at the table, and also yesterday, all those institutions which have already taken initiatives. They have already been moving. One of the problems we have in Europe is that many do not move. There is, to a certain extent, sometimes there may be a bias to inaction, and sometimes there may be a lack of instruments. So we need to find a way to combine flexibility at the local level with the fact of being ensured that our continent has a capacity to respond in its own regions, because at the very end, if there is a problem which materializes somewhere, all of us will be affected.
Thank you. And since our fascinating policy discussion is going to an end, we have a few more minutes for some questions from the audience. And we have one addressed to Mr. Jacob, but I think others could also comment on that. And the question is whether, the ECB or some other institution should have a right to top up the borrower-based measures. And many of you, commented on that, but could you elaborate on this? What would be, the pros and cons of such changes in the legislation?
I would say that I have mentioned it mainly for completeness' sake, because it exists for the other macroprudential policy tools. Personally, I think that could go a step too far, but I would like to hear from those who have practical experience with borrower-based measures at the national level, whether they would like to, how they would see that. Is there a big risk of inaction based? I would agree with Francesco that we have a biased selection of participants here. We have the good pupils as far as borrower-based measures are concerned. But would you regard it useful to have the ECB topping up borrower-based measures? I don't know. We should probably try other things like more coordination in a kind of voluntary manner to see to try to achieve that the tools are used in a kind of consistent manner across member states, depending on the actual needs observed in those countries.
Thank you, and maybe we can end the discussion with some comments on this topic from Sharon and Luis. Again, you mentioned already about this topic, but if you could, summarize.
Thanks again. So maybe just on an action bias first. So I think obviously the Irish crisis did loom large in the minds in terms of the introduction of the measures. And of course, there had been a very direct experience of the negative effects of credit price bubble, etc. This was the sort of backdrop or context, I think, for when we introduced the rules. And of course, that experience informed the debate about the rules and the perceived trade-offs between the cost and benefits of the rules. That is becoming, I would say, more challenging as time passes and as people maybe forget or become more distant from the global financial crisis. And of course, on people's minds now is more the pandemic. But the other thing that we have done to mitigate inaction bias is this structure of regular reviews, which we introduced a couple of years ago. So we do review the mortgage measures every year in terms of their effectiveness. And then we're having this deeper framework review at the moment. And I think our plan would be that, on a periodic basis, every 5-7 years or something like that, we would do these deeper reviews, akin to the way the ECB has announced it will regularly review its monetary policy frameworks. On the local versus ECB issue, I mean, first of all, I would say we're obviously generally very supportive of cooperation and coordination across the Eurosystem and with the ESRB and with other regulators and so on. But as has been touched on by the panel, there are many local consequences for these rules, social consequences for the households and individuals and families that are affected by these rules. So I think we also feel very strongly that the decision making has to be close to those individuals who are most affected. And of course, that there is, as I mentioned, this public accountability dimension. So myself and my colleagues at the bank, for example, are accountable to our local parliament to come and explain the measures and our thinking and so on. And as I said, we do have these very frequent dialogues with civil society, with consumer groups and so on. So I suppose they are also, through that, society is being close to the decision making. So I think even if there was any structural change in the future and maybe there's potential around things like guided discretion, which was cited, I think, as a good potential example, I think you have to protect the institutional arrangements that allows for that local dialogue, that local and direct accountability as well. Thanks.
Thank you, Sharon. Very, very important points. And maybe we can close the discussion with some comments from Luis. And you clearly stated, local versus pan-European decision making. But maybe you can comment a little bit on inaction bias and how you deal with that in Portugal.
Yeah. If I'm allowed just 10 seconds to go to the previous question, whether or not we should extend the toolkit just on a conceptual basis. I would like to add that there's no such thing as a silver bullet. So conceptually, I think we should try to extract the most out of the existing toolkit we have, because adding new tools always has some regulatory burden. But having said that, that doesn't mean that we should not be open to extend the toolkit, because as I said, there's no silver bullet. So sometimes you need to add new tools. On the topic you mentioned about this last topic about the flexibility and the inaction bias, I would subscribe to the expression of, at this time, it would be a step too far to go in that direction of topping up. And I would say at this time, and as far as inaction bias is concerned, I have to speak based on the experience we've been having so far. And I don't think inaction has been one of the problems we've had from looking at it from a Portuguese perspective. So I cannot predict the future. I don't know what will happen in a few years' time, but based on our current and past experience, we don't feel that problem, and we feel comfortable with having this degree of flexibility that it's embedded currently in this kind of measures. So it would have to be any decision of removing this flexibility would have to be taken very carefully to see and understand exactly what is the benefit, and if the benefit is related to it doesn't undermine this capacity that has to be in place to address local specificities and imbalances that are felt at local level sometimes, arising from, as I said, things such as the monetary policy, which is defined across Europe.
Luis, and thank you all for your valuable contributions and comments. And I think we are leaving this panel 5 minutes late, but with very important principles and insights how we could shape, borrower-based measure framework for the next decade. So thank you once again, and goodbye.
Thank you. Goodbye.
Thank you very much to the presenters and to Simonas for a very interesting panel discussion. Before opening the fourth panel, let me remind the viewers that your opinion is extremely valuable to us. Therefore, we're kindly asking you to leave your opinion and your comment about this conference in the poll section that can be found just in the top bar of the comment section. So, let's now turn to session 4. That will be discussing the side effects of borrower-based macroprudential measures and the ways of mitigating them. I would like to invite the first speaker, Mr. Luis de Mello, who is the Director of Policy Studies in the Economics Department of the OECD. Earlier in his career, Mr. de Mello held senior positions at the OECD, including serving as the Deputy Director of the Public Governance Directorate, as well as being the Chief of Staff and Counselor to the Chief Economist of the OECD. Prior to joining the OECD, Mr. de Mello also worked with the Fiscal Affairs Department of the International Monetary Fund. Mr. de Mello, my great pleasure to invite you here, and please, the floor is yours.
Okay, good morning, everyone. Thank you very much for your very kind introduction, and thanks for the invitation to participate in this panel. Congrats on the conference. This is a very important topic for policy, and it's the right moment to really try to collectively improve our knowledge about how borrower-based prudential measures can contribute to a better functioning of housing markets. What I will try to do, the next slide, please. What I'll try to do in the next few minutes is to basically make 4 points, which I hope will provide good background to the discussions. One is that it's needless to say, but just to reiterate the fact that house prices have risen very sharply in many countries in the OECD area, including during the pandemic. There is also an important point to make that there are several drivers of house price increases, including most notably, I would say, supply restrictions that stem from a number of regulatory measures, among others, and that then impede this increase of supply in line with the rising demand. So this is really what is at the core of the gradual increase in prices that we are seeing in many parts of the world. Also, a third point I would like to make is that the borrower-based macro-pru measures are very useful to deal with macro spillovers from the housing sector. So to break that correlation that we know exists between house price cycles and the business cycle ultimately. And my final point, and I would say probably the most important from the point of view of this panel, is that we need broader housing policies to deal with the affordability challenges we are facing. There is no single instrument that will solve the problem, and I will briefly discuss a few of them in the light of our recent analysis. Next slide, please. So just a chart to recap across a variety of OECD countries, the trends that we are seeing over the last 20 years in house prices and rents. And you will see the countries in the far left of the chart that have had, more than a doubling of house prices over the last 20 years, and a very big variety of situations when it comes to real rent prices as well in those economies. But this was the situation before the pandemic. The next slide shows essentially the situation since then. And then you see a correlation between those countries that were experiencing large increases in prices until the end of 2019 and the countries that have continued to experience house price increases in the course of the pandemic. So pretty much where prices were rising fast, they continue to rise fast since the onset of the pandemic. Next slide, please. And here is a slide that illustrates what has come across in previous panels as well in this conference, is that there is a very strong association between periods of sharp corrections in house prices and the share of economies, the number of economies that are facing severe recession. So house prices, boom and bust cycles do affect downside risks in the real economy. Hence, the need to deal with the efficiency of house price or housing markets as a way of mitigating those risks of a systemic nature in our economies more broadly. The next slide, please. This is basically to illustrate the variety of regulations that we see in OECD countries and beyond. This is just one example of loan-to-value ratios, which are, as we all know, the most common macro-pru instrument available and used throughout the OECD membership. We see other regulatory ratios, for instance, macro loan to or debt service to value ratios, to income ratios, being much less widespread than LTVs throughout the countries that we've been monitoring. And basically, essentially, showing the variety of stringency in those regulations across OECD countries. Next slide, please. This is essentially a recap of work that my colleagues Boris Kurned, Sarah Saka, and Volker Zeman have done here at the OECD, that essentially shows that LTV caps are associated with lower credit and house price growth. Essentially what they did in this exercise was to use propensity matching techniques to basically identify episodes of tightening of LTV regulations and periods where there was no such tightening, and then compare that and see what happened between those two groups of episodes in terms of credit to household, house prices, housing investment, and private consumption more generally. And what we can see from the chart is that indeed LTV, a tightening of LTV caps is associated with lower credit to households, somewhat lower increase in house prices, and a much less discernible impact on housing investment and private consumption more generally. So all that on the face of it essentially to show that a tightening of such regulations is associated with a modest reduction in the rate of growth of house prices over the period in which the policy regime is changed. So it is a good first-hand indication of the effectiveness of those policies in curbing house prices. But we know, and that's probably a point to highlight here, is that there are unintended consequences in terms of a heterogeneous impact on the cost of borrowing across different classes of borrowers that then would have an impact of a distributional nature when one considers the overall efficiency and efficacy of this type of measure as a tool to deal with affordability challenges arising from the increase in house prices. Next slide, please. Another point that I would like to make beyond the conventional macro-pru instruments is also the role of risk weights when it comes to assessing the credit worthiness of borrowers in terms of mortgage loans across the OECD membership. So we see that those risk weights vary considerably when it comes to mortgage loans in the membership. And it is another instrument that is often associated with a reduction in the increase of house prices, and then the vulnerabilities associated with the exposure of different, or probably the most fragile asset classes to changes in macroeconomic conditions. So bearing that in mind, the next slide, please, essentially shows a correlation for a small number of countries, admittedly, between higher risk weights on housing loans and the ability of those economies to recover from a shock, and that bearing in mind the example of the great financial crisis. So another instrument that is associated with a mitigation of the undesirable consequences of a high amplitude, if you want, of fluctuations in house prices in our economies. Next slide, please. The issue now is mortgage debt is basically borrowing to finance home ownership a good way of dealing with the affordability problem. I think what this chart is showing is that mortgage debt may in fact aggravate the burden of housing costs. If you look at the lower income segment in society, so those households that are in the lowest quintile of the distribution of income and spending, what we see is that those that are facing the harshest burden associated with housing, so those who spend more than 40% of their disposable income on housing, essentially there are in many countries those that basically where the bulk of the burden of housing comes from precisely honoring their mortgage obligations rather than rent, and in the case of a subsidized rent especially. So a preference for home ownership as the tenure choice for households that can be facilitated via borrowing this burden of housing costs in household budgets. And what we've been seeing is that throughout the OECD membership, there has been a decline in investment, be it directed investment or public capital transfers for housing development over the last 20 years or so. So countries are investing less in housing, and with that, the supply of social housing, the subsidized rental or owner segment has been shrinking over time, at the same time that prices are increasing. So one point that we've been trying to make is that it's very important to also revisit all the policies associated with housing, social housing investment, as a way of alleviating the pressures on household budgets. Next slide, please. And this is, if we are looking more broadly, and that was the point that I was making at the very beginning, if we look more broadly about policies that can unlock supply to meet the increase in demand that we are seeing, there is a host of policy areas that need to be looked at. We looked, for instance, of rental markets, so basically regulations on household tenant relations, and then we see that those countries where those regulations are less restrictive tend to have a higher supply of houses, of dwellings, if you want, in the rental market segment. So basically, unlocking opportunities for that, developing the rental market is another way that can contribute to alleviating the affordability challenges that we are facing. Removing mortgage interest relief, we know that that's an instrument in the tax code that tends to create a bias towards home ownership. So countries that basically do away with that type of preferential tax treatment are also the ones that can have an expansion of supply in tandem with demand. We also looked at land use policies. So basically, land use policies that are less restrictive are basically those that can facilitate an increase in supply when demand increases. So just the three examples of policies that have a very strong impact on supply and that can then contribute to reducing prices and making housing more affordable. And to conclude, a last slide, please, which essentially shows another very important consequence of facilitating post-pandemic reallocation. And I'm saying this because we are seeing in many parts of the world that residential mobility, which has been falling in many places because of rising house prices, because of difficulties that households have to move to areas in the country where jobs may be more abundant, that creates an obstacle to reallocation post-pandemic. So this link that exists between residential mobility and labor mobility is an important one that we need to tackle as our economies emerge from this pandemic, and as sources of growth in the future will need to involve some degree of reallocation of capital and labor. And I'll stop here just to give this very broad overview of policies related to affordability more generally, and to make the point that we need to go beyond the regulatory considerations and take on board a variety of policies that affect supply as well. But with that, thank you very much for your attention. I look forward to the debate. Thank you.
Thank you very much, Mr. De Meo. Now I would like to introduce the second speaker of this panel, Mr. Pierre Monin, who is a senior fellow at the Council of Economic Policies, where he works on central banking, monetary policy and financial regulation, with a particular focus on their interdependencies with environmental and social sustainability. Prior to joining the Council on Economic Policies, Mr. Monin worked at the Swiss National Bank. Mr. Monin, my pleasure. Please, the floor is yours.
Thank you very much, and thank you very much for the kind invitation to this conference. Also, a special thanks for organizing such a session. When you look at policy measures like a borrower-based measure, it's also very important to look at the side effect, and especially the side effect on inequality. And because, as Governor Simkus yesterday pointed out, the increase of inequality is a challenge for our society in general, for the cohesion of society, but I think it is also a challenge for central banks and financial regulator in general, because policies that have large side effect on inequality are less likely to get support from the general public and from the people that are affected by it. That being said, I think there is especially important to look at the side effect of borrower-based measures, because there is a cause for concern about them having an impact on inequality. It seems evident, and it has been also pointed out before, that more stringent ratio restrict access to housing wealth for some part of the population, the low income and low wealth households. So with restricting this access, it increases inequality and wealth inequality, income inequality. But on the other hand, these measures also prevent financial instability, and low income, low wealth households are the ones that are the most impacted by crisis in general. So there is clearly here a trade-off in implementing this measure when we look at inequality. And the question is which balance to strike, and also maybe can we find alternatives to this measure or other measure to circumvent the possible negative side effect of a borrow-based measure on inequality. So this is what I would like to do for the next 15 minutes. I would first try to highlight the links between prudential regulation and especially borrower-based measure and financial stability and inequality. I would like to go through one case study on LTV and DSTI on mortgages in the euro area. And then I will try to explore some options that could mitigate the side effects of a borrower-based measure without endangering financial stability. So let me I just made a little sketch to see how financial stability, borrower-based measure, and income inequality interact. So I think I don't have to convince anyone here that the borrower-based measure are very useful in fostering financial stability. That's their purpose. They are first and main purpose, actually. And there is evidence around the world that these measures are efficient in strengthening financial stability. Now, this is something good because financial instability is very disequalizing. So low income and low wealth households are the ones that suffer the most in case of an economic crisis, and an economic crisis that is triggered by financial instability. So by fostering financial stability, borrower-based measures do something good for inequality. In a sense, they have an equalizing effect. Now, the problem and the concern is that this is not the only effect they have. They also have a more direct impact on income and wealth inequality. As I said, such measures restrict access to housing wealth for some part of the population, especially to low income and low wealth households. And they restrict this access more than for other households. And housing wealth is a source of income and wealth gain for those who can acquire it. Then by restricting the access to housing wealth, borrower-based measure prevents some households to benefit from that. And this is disequalizing. So it increases wealth and income inequality. Now, the big question is, how do these effects combine? The positive effect for more financial stability compared to the negative effect of restricting access to housing wealth? And this is largely an empirical question. It depends on the structure of the economy, on the strength of the measure, and on financial instability in general. So, to shed light on this overall impact, I just wanted to present one case study that has been recently published, which is on loan-to-value ratio and on debt to income for mortgage in the euro area. And I base these results on a working paper that has been presented very recently by the ECB, and the authors are Ona Maria Georgescu and Diego Villamartin. And so they published it this June, and they basically looked at the impact of LTV and DSTI on 4 economies: Ireland, Italy, the Netherlands, and Portugal. and they looked at they used the data from the household finance and consumption survey of the euro area, so data at the household level, and combined with bank level data from the 2018 euro area stress test exercise. And what these authors did was to look at 4 scenarios. One scenario, which is a baseline scenario, and the other one an adverse economic situation scenario. So basically a boom scenario and a recession scenario, which are both associated with financial stability and financial instability. And for each of these scenarios, they look at what would be income and wealth inequality with borrower-based measures and without borrower-based measures. So with this example, we can see what is the impact on borrower-based measure on income and wealth inequality in a good situation, economic situation, and in a bad economic situation. So their main findings are the following, and I will focus on wealth inequality first. So what the author find is that borrower-based measure increased wealth inequality in good time. So this is not surprising. So as housing is one main source of wealth for low-income and low-wealth household, if you limit the access to housing wealth, the borrower-based measure limit are more binding for low-income and low-wealth household, as we have seen in some presentation yesterday. So if you limit this access, then the low-income and low-wealth households cannot benefit from the wealth and income gain linked to the housing market in good times. Now, what they find, which is more surprising, is that in bad times, in recession, borrower-based measure also increase wealth inequality. And this is a bit surprising. This could be surprising because, in a recession, in a financial crisis, low income and low wealth households are shielded from a negative wealth shock. They don't have this wealth, so they don't suffer the wealth loss. But what the author find is that this does not compensate for the barriers to access housing wealth. So the remaining benefit of having housing in a bad time scenario do not compensate for the barriers to access this wealth. So we see that in both situations, loan to value ratio and debt to income ratio tend to increase inequality. For income inequality, the impact is negligible on both cases. So this is what they find, and this is concerning because, as I said, the borrower-based measure seems to have a negative impact on wealth inequality, at least. So now the question is are there options to mitigate this side effect? And especially, can we find solution to have best of both worlds? So mitigate the impact on income and wealth inequality, but keep the stabilizing power of measure and the stabilizing effect on financial stability, which is good for income inequality. So here I would like to explore some options. It's just proposition that I would like to lay out in front of you to discuss that. And so the first option is to focus more on debt to income ratio rather than loan to value. This would allow people with low wealth but with a steady stream of income to still access the housing market. We show that wealth, the absence of wealth, is one big bottleneck to access housing market. Here in Switzerland, where salaries are pretty high, there is still a huge barrier to enter the housing market because you have to have large initial wealth. So that could be one way to open a bit the housing market while keeping the benefit on financial stability with LTV. Now the second option is to lower requirement for first buyers. That would help these buyers to enter the housing market, but then we could have a higher restriction for second times buyer. So this is not clear what will be the effect in general. What could be clear is that if you limit access to second time buyer, then you might also decrease the growth of housing prices, which could be a good thing for financial stability. Now, what I think is the most promising measure is to shift to capital-based micro or macroprudential measures. So if borrower-based have a negative impact on inequality, capital-based impact is less evident. So by shifting to more capital-based, we would loosen the impact of borrower-based measure while keeping the stabilizing power of capital-based measure for the financial system. Another thing would be to increase macroprudential buffer. So again, if we have looser policies in terms of borrower-based measure, then we could compensate for higher risk for financial market by increasing macroprudential buffer in general in the economy, and then increase the resilience of the system to compensate the decrease in resilience by loosening borrower-based measure. And we've seen in the previous session that there is a framework for that in Europe. Systemic risk buffer do exist, can be implemented, and this could be a possibility for financial regulation in Europe. Now, the last solution or option that I would like to mention is implementing public guarantee schemes. If we loosen requirement for borrower-based measure for low-income, low-wealth household, for example, this would increase, the risk for banks, and we could find a way to compensate this risk for banks by guaranteeing some of the loans. So that should be discussed in cooperation with other authorities in general, and we have seen in the previous presentation that there are many options possible in terms of other policies. Now, finally, I would like to end up with kind of a provocative thought as well, in a sense that maybe we can lose a borrower-based measure for low-income and low-wealth people, and that might actually have a beneficial impact on financial stability. So to come back to the little sketch that I did before, there is one arrow missing, and this arrow is from income and wealth inequality to financial stability. What we have seen that there is basically a positive link between inequality and debt growth. So higher inequality is usually associated with higher debt growth. So and higher debt growth is higher risk for the financial system. In fact, there are some studies like Kirschenmann, Marin, and Nieberg that have empirically explored this hypothesis that income and wealth inequality could trigger some financial instability through higher debt. And they have looked at a data set of 14 developed countries over the last century. And then they find that inequality has the highest predictive power for financial crisis among all the variables that they use, including debt growth. So income inequality is a predictor for financial crisis. So if we increase income inequality by lowering borrower-based measure, in the long term, this decrease in inequality could also foster financial stability in the very long term. And I would like to let you with that. I'm happy to discuss the option and these thoughts in the panel after the next presentation.
Mr. Monin, thank you very much for the very interesting presentation. And I would now like to introduce a very special guest calling from a very far away, Ms. Nitzan Sur-Ilan, who is a research economist at the research department of the Federal Reserve Bank of Dallas. Ms. Sur-Ilan, before joining the Federal Reserve Bank of Dallas, was working at the research department of the Central Bank of Israel. And she also holds a PhD in finance from Hebrew University, and her main areas of research interest are household finance, real estate, macroprudential policy, fintech, and climate change. Ms. Sur-Ilan, it's my great pleasure to have you here with us. I know I'm very well aware that it's a very early morning in Dallas, so very pleased to have you here with us today. Please, the floor is yours.
Hello, everyone. Thank you very much for the opportunity to present here today. So as mentioned, my name is Nitzan Sur-Ilan, and I'm a research economist at the Federal Reserve Bank of Dallas. So the usual disclaimer applies. This is only my views and not necessarily the Federal Reserve's views. I just want to mention that it's 3:45 a.m. in the morning right now in Dallas. So please forgive me if I'm not 100% in focus. So today's presentation is about the side effects of ball-based measures and how to mitigate them, inequality and distributional effect. And first of all, in order to better understand the inequality consequences of macroprudential policies, I would like to start with the objectives of macroprudential policies. And then I'll talk about the development of macroprudential policies in terms of the literature and in terms of countries' experience in implementing macroprudential policies. And then I'll talk about what we know about the direct effect of macroprudential policies, and specifically borrowers-based measures. And then I would like to talk about the indirect effect, what we know and what we don't know yet. And then I'll talk about the Israeli experience in implementing macroprudential policies. So before I joined the Dallas Fed, I used to be a research economist at the research department at the Central Bank of Israel. And Israel has large experience in implementing macroprudential policies. So I think that we can learn a lot from the Israeli experience in ball-based measures. So I start with the objectives of macroprudential policies. I think that we can agree that macroprudential policies are defined as the use of primarily prudential tools to limit systemic risk. And a central element in this definition is the notion of systemic risk, which can cause serious negative consequences for the real economy. And I think that this is the link between macroprudential policies and the housing market. So therefore, should macroprudential policy target real estate prices, housing affordability, inequality? Those are the main questions that I'm going to discuss today. Also, should inequality factor into central banks' decisions? So in order to better understand, I looked online at the Bank of Israel targets on their website. And it mentioned that the unique target of the Central Bank of Israel is also the government economic advisor. So therefore, in order to support the objective of the government's economic policy, especially growth, employment, and reducing social gaps, so the Bank of Israel does mention that one of their targets is to lower inequality, also to support the stability of the financial system. And one can argue that inequality leads to financial crisis. So therefore, in order to stabilize the financial system, one element that the central bank should focus on is inequality. we started talking about macroprudential policies mainly after the global financial crisis in 2008, and this is for advanced economies. But for emerging market, the experience with macroprudential policy started before that, because those emerging markets experienced financial crisis in the 1990s. So here I generate maps using the IMF data on countries' experience in implementing macroprudential policies. And what we can see here is the number of macroprudential policy tools that were implemented in different countries in the 1990s. So what we can see is that in the 1990s, only few countries had macroprudential policy in place, and only few different macroprudential policy tools. And in the last decades, more and more countries are using macroprudential policy tools, and not just one tool, but many tools, between 6 to 43 different types of macroprudential policy tools. So it's becoming more and more popular to using macroprudential policy tools. But we can see from a paper of researchers from IMF, Alam et al., that find that loan-to-value limit is the most popular tool among advanced economies. So most of the countries that used macroprudential policies used loan-to-value limit. And therefore, in my discussion today, I'm going to focus mainly on this tool of loan-to-value limit. It was found to be the most effective tool, macroprudential policy tool. So what we know about the direct effect of macroprudential policy? The literature on macroprudential policies had gone through extremely progress in terms of understanding the goals and developing a toolkit for macroprudential policies. So we know already the targets of macroprudential policies, the different types of tools of macroprudential policies, and we also know that macroprudential policies manage to accomplish their main goal, which is lowering the risk in the financial system, reduce credit growth, and building a broader financial resilience. So macroprudential policies in general manage to accomplish their main goal of lowering the risk in the financial system. But what about housing prices? The question about the effect of macroprudential policies on housing prices, and specifically loan-to-value limit, received considerable attention in the literature in the past decade, but with mixed conclusions. And the summary of this question is in the paper of Steve Laufer and myself from 2019. In general, there are some studies that do find that loan-to-value limits reduce house price growth, but there are other papers that do not find any effect of loan-to-value limits on housing prices. And in general, even those studies that do find an effect of LTV limit on housing prices, the effect is small. So in general, loan-to-value limit might not be the right tool to affect housing prices. What about the indirect effect of macroprudential policies? So it's important to understand that macroprudential policy tools usually come with a cost, unintended effect, and leakages. So when I say leakages, I mainly refer to the transfer of credit from the regulated part of the market to the unregulated part of the market. So usually unregulated is the non-banking sector, or there are evidence that transfer of credit from countries with regulated banks to countries with non-regulated foreign banks. What about unintended effect? So when you face a binding LTV limit, a household can adjust by purchasing a smaller and cheaper houses, and this is what I found in my research, and I will elaborate more about it later on. Household can use other financial assets to fund a larger down payment, or to delay purchase of housing unit, for instance, to keep renting and not to buy a housing unit. Other costs is spillover effects on output and inflation. And there are already some papers that found that macroprudential policies increase inequality, income inequality, and wealth inequality, as presented in the last presentation. But in general, I argue that much more progress needs to be done in order to better understand the effect of macroprudential policies on inequality. And for that, we need better data, access to better data. And let me start with the remaining time to talk about the Israeli experience in implementing macroprudential policies. So in this figure, you can see that Israel, as a small and open economy, was affected by the low interest rate environment after the global financial crisis. And because of supply constraint, housing prices more than doubled themselves since the global financial crisis. And actually, housing prices continue to increase until today. And therefore, the Bank of Israel implemented a number of macroprudential policy tools. And I think that the experience of implementing macroprudential policies, the experience of Israel, is interesting because Israel has large experience in implementing those tools. So they started in 2010, and not just one tool, but many different macroprudential policy tools. So in October 2010, the Bank of Israel implemented the soft LTV, and I'll elaborate more later on what is soft LTV. And then in 2012, a strict LTV limit. And also, the Bank of Israel implemented other tools, payment to income ratio, limit on the loan duration, capital requirements, increase risk rates, etc. Overall, those macroprudential policy tools intended to, first of all, to reduce the risk in the financial system. So the main target was not to affect housing prices, but to reduce the risk in the financial system. The second target, according to the press release, is to prevent households from over-leveraging, and only the third target is to lower the demand for housing. But you can see in this figure that those different macroprudential policy tools were not very effective in stabilizing the housing market. So what you can see here, is the blue line is the growth rate in housing prices in Israel from 2007 until 2015. And in vertical lines are the different macroprudential policy tools that were implemented. Here is the soft LTV and here is the strict LTV. The red line, the red period of time here is the time that I focused on in my papers. It seems like that the soft LTV managed to lower the growth rate in housing prices, and I just don't want you to misunderstand this figure. So what you can see here in the blue line is the growth rate in housing prices. So every time it's positive, it means that housing prices continue to increase. So it seems like that the soft LTV managed to lower the growth rate in housing prices, and the strict LTV did not. But the challenge here, and in many other cases, is to defer the effect of macroprudential policy tools on housing prices from all other things that happen in the market in the same time, and specifically like in the same time happened the social justice protest and other macroprudential policies that were implemented in the same time. And this is what I do usually in my work. In order to better understand the Israeli experience in implementing macroprudential policy tools, I gave you 3 quotes from the book of What Have We Learned After the Global Financial Crisis. There are many evidence of different governors in this book. I highly recommended you to have a look. Today I'm going to focus on the chapter Macroprudential Policies in Action that was written by Stanley Fischer, who was back then was the governor of the Bank of Israel, who is the one that implemented those macroprudential policy tools. And I think that we can learn from what he wrote in this book The first one is that he mentioned that that set of measures contain one element that is not fully consistent with risk management. So the Bank of Israel limit the LTV to 75% for first-time home buyers and 50% for investors. And I will elaborate more about it later on, but it's clear here that that was included for political reasons, as first-time home buyers are riskier than investors in terms of wealth, income, etc. So it's not usually purely pure macroprudential or financial consideration. It's also political consideration that takes into consideration. The Bank of Israel have been subject to far more criticism over some of the macroprudential measures we have imposed than over our standard monetary policy measures. We should remember that macroprudential policies is a new toolkit, and therefore we should consider the bank's independence in implementing macroprudential policies. The third quote is, why should we worry that macroprudential policy has distributional effect? Because politicians worry about those distributional effects. That means they will push harder on us to take their preferences into the area into account, and we need to figure out how best to react to that. So we need to take into consideration not just financial stability concern, but also political concern. What about the soft LTV? So as I mentioned, my research focuses on loan-to-value limit, soft and strict one. The soft one was in October 2010, and the banking supervision in the Bank of Israel required the commercial banks to increase capital provision for loans with LTV above 60%. And the interesting thing in the case of the soft LTV and then in the case of the strict is that this guideline did not apply to housing loans below 800,000 shekels, which is around $200,000, which back then was the average loan amount. So the Bank of Israel differ between lower income or lower loan amount to higher loan amount and implement those tools, specifically here the soft LTV, only for higher loan amount. And for me in my research, it helped me to differ between the effect of loan-to-value limit on housing prices. Same thing for the strict LTV limit. In October 2012, the Bank of Israel required the commercial bank to limit the LTV ratio to 75% for first-time home buyers, 70% for upgraders, those that need to sell their first home within 18 months, and 50% for investors. We can clearly see from the case of the strict LTV that there are some political considerations that were taken into account, because usually first-time home buyers are riskier than investors. However, here they were limiting 75% compared to 50% for investors, as one was mentioned in Stanley Fischer chapter. So some evidence on the inequality or the distribution effect of the soft LTV and the strict LTV. I'm not going to go over all the details from my paper, but in general, the LTV limit required the commercial bank to set aside more capital against risky loans with LTV above 60%, to increase capital requirement on those loans. And I use loan level data from the Bank of Israel, which include detailed information on borrowers, housing unit, mortgages, so I can better assess the effect of this tool. Without getting into the details, I find that after the soft LTV limit, the interest rate that paid by the borrower with LTV above 60% is around 0.21 to 0.36 percentage point higher than similar borrower in terms of observable characteristics, which means that the one that stayed highly leveraged above the 60% paid higher interest rate of around 300,000 shekels, which is around $100,000 US dollars. And the borrowers reacted, and it's very interesting to see in the case of the soft LTV that here is the distribution of LTV before the soft LTV limit and after the soft LTV limit. And you can clearly see that there are some borrowers that decided to stay highly leveraged, and those are the ones that paid higher interest rate. And there are some borrowers that, because of the increased interest rate, lower their leverage to around the 60% LTV ratio. And now they have less credit to purchase a housing unit, but using the detailed loan level data that I have, I can better assess who are the ones that lower their leverage. And we can clearly see from those figures that the one that continue to stay highly leveraged, around 70-75% LTV ratio, are the one with that are more financial constrained, like lower income households, younger households, first-time home buyers, and the ones that lower the leverage and paid less interest rate are higher income household, older investors, etc. Another result from the paper is that I can better understand which kind of housing unit the affected borrowers are choosing. So here is the distribution of the change in distance from Tel Aviv. Tel Aviv is the central business district in Israel. And what we can see from this figure is that households are choosing affected household after the soft LTV to buy assets far away from the city center. And in general, 70% of the borrowers are moving far away from the city center after the soft LTV limit. And it's not just they just moving far away from the city center, they're also moving to lower socioeconomic neighborhoods. So here I divided this distance from Tel Aviv to 3 different categories: those that increase their socioeconomic level of their neighborhood, and those that decrease, and those that did not change. And for each subgroup of distance from Tel Aviv, there is significant decrease in the quality of neighborhoods. So more borrowers are moving to lower socioeconomic neighborhoods. Another result from the paper is the unintended or the leakages from the strict LTV. So unfortunately, I don't have good data on other type of loans, not mortgages and not from the banking system. But using macro level aggregate data, I can see that after the strict LTV, there was a clear shift from mortgages to other type of credit, consumer credit. So borrowers are using other types of loans in order to increase their down payment and to keep purchasing the same housing unit. And of course, this consumer credit is riskier, unsecured, and more expensive, etc. So let me give you briefly the conclusions for my paper is that LTV limits affect mortgage contract term, increase interest rate. Borrowers are buying cheaper assets that are far away from the city center in lower socioeconomic neighborhoods. And the main takeaway that I want you to take from the presentation today is that while those macroprudential policies have a lot of other advantages in stabilize the financial system, they have also micro implications on location choices, increasing commuting costs, which I find in the paper, and moving to less advantaged areas. The conclusions from the overall presentation today is that while macroprudential policy made impressive progress in terms of the literature, in terms of country experience, and managed to reduce the probability of another crisis, borrower-based measures should be less stringent for lower-income households, as been seen in the case of Israel. Borrower-based measures should cover all types of lenders to avoid leakages, as shown of the shift from mortgages to other type of credit. Borrower-based measures should interplay with broader housing policies, so to collaborate with other institutions or other government in terms of housing affordability. I argue that more work and better data is needed on the distributional effect of macroprudential policies. And last, I think that while there are good reasons to isolate the interest rate decision from political control, that may be less true with regard to macroprudential policies. So my suggestion for next year session on macroprudential policies is to focus on the independence of the central bank in implementing macroprudential policies, and specifically borrower-based measures. Thank you very much for listening.
Thank you very much, Ms. Surilan, for a very interesting piece of research. And before opening the panel, I would like to remind our viewers that you are able to ask questions or post comments in the comment box that can be found below this video translation. Now it is my great pleasure to introduce a special guest, a moderator of this panel, Ms. Katja Taipalus, who is the head of the Financial Stability and Statistics Department of the Bank of Finland. Ms. Taipalus, who holds a PhD degree, has joined the Central Bank of Finland in 2001 and has been working in various roles, both in the areas of financial stability and monetary policy. Ms. Taipalus, my great pleasure to have you here with us today. Please, the floor is yours.
Okay, and thank you very much for the kind invitation to chair this especially interesting session concerning the borrower-based tools. I see that there is already quite a lot of questions in the questions and section, so I will begin straight away with those. So concerning the evaluation of the borrower-based tools, so which points do you think that should be taken into account when evaluating their costs and benefits and their impact to the inequality? And I think that this question goes to all of you. So who wants to begin? Luis?
I can have a go, Katja. Thanks for that. This is indeed a very interesting question. I would say, frankly, that what is important to bear in mind when you are assessing this type of policy, or any type of policy really, is what objective it is that is your foremost objective when implementing this. If your concern is really financial stability, and I think that is what cut across our three presentations before. Pierre and Itzan also mentioned this, that we are really facing potentially a trade-off here. And we know that there is stronger evidence in favor of Macropru, especially the ones that we looked at. And the three of us, we looked at LTV since they are the most popular ones. And we showed evidence that they tend to be very effective in terms of contributing to financial stability, but there are those unintended consequences that need to be looked at. So if in your country the issue is one of financial stability and the need to mitigate some of those vulnerabilities arising from the housing sector, then you are well served by looking at the design of LTVs or any other such Macropru regulations on housing. But if your main concern is the one related to affordability, then there are a host of other policy areas that you need to look at, including more fundamentally, and that's the point also that I think is important to make, is that, do we need to have a preference in policy towards home ownership as the type of tenure that should be most widespread in the housing market? We see the experience of OECD is that there is a huge variety of country experiences. You have countries where home ownership is extremely high. Think of Southern Europe, where home ownership rates are above 80%. Take also the countries in Central Europe, countries in the Baltics, since we're being hosted by Lithuania now, where home ownership is also very high for a completely different set of questions, namely the transition away from central planning and how the privatization of housing stock took place. So those are countries where there is already extremely high home ownership rates. So do we need to support more home ownership in that context? And you see other countries in Central, take Germany or Switzerland, for instance, where the rental market segment is really huge relative to other tenure types. So I would say that let's think of a different set of probably nested questions. Is there a role for policy in fostering one type of tenure relative to the other? If so, if you are looking at options to foster home ownership, and since borrowing is the main vehicle for that, are we trying to address with policies issues related to vulnerabilities, the build-up of downside risk in financial sector, so issues related to financial stability, or others? Namely, given the topic of the conversation today, affordability and what can be done in that area.
Thanks. So, Pierre and Nizan, any views about this?
Can you hear me?
Yes.
So I think, as Louise mentioned, there is really here a trade-off between the benefits of such measure in terms of financial stability, which have really benefits also in terms of inequality, because financial crisis and recessions are a big driver of increasing inequality. So if you can mitigate them, that's good. But on the other hand, there is also this potential access to housing wealth, which is narrowed down, and when some households are excluded from this market, they are also excluded from a source of income, a source of stability, and a source of wealth. And this is very difficult to weight on one side the economic stability and this direct impact. So that's a trade-off that you have. But I think what is very important is not just to look at this trade-off in terms of are we implementing this measure or not. We should also look at, are there other options which allow to sustain financial stability, to keep economic stability, but mitigate on the other side the impact. And the impact on inequalities, the restricted access to housing. So I try to give some option where you could maybe shift the importance of borrower-based measure to other measures that have a positive impact on financial sustainability, but maybe less impact in terms of inequality and access to the housing market. And I think the central bank should not just look at pros and cons of the borrower-based measure for itself, but they should also look at all the set of other options they have to achieve the main objective of financial stability while not impeding too much on inequality.
Thanks. So, Nizan.
Yes, thank you. I think that it's very complicated to understand the overall cost and benefits of those types of tools. I'm not familiar with any paper that discuss this complicated picture, the overall equilibrium. Because in order to do that, we need better data, more historical views. As mentioned, those are fairly new policies. What I can tell is that, for instance, in Israel, 2 years ago, they established the Financial Stability Committee that gathered together the central bank, other financial regulators, the government, and other institutions in order to discuss, share data, share information about each institution, each financial institution view on the financial system. And I think it's very important to do this kind of conversations in order to mitigate leakages, as mentioned, to examine other financial institution concerns and other housing market goals, to discuss, for instance, affordability, housing programs, etc. Thank you.
Okay, thanks. I actually refer to your latest point, a couple of questions related to that one. So do you think that the design of the structures, how the decisions are made, could have an impact? So maybe a wider set of views in the decision-making process, could that have an impact to the way that the borrower-based tools, for example, are used? So the decision-making structures, in addition to the basic central bank view, so do you think that it would make additional use if there would be combined views from a little bit wider set, something that Nissan referred just a while ago? So, Luis, Pierre, do you have any views about that?
So you mean by incorporating more stakeholders in the decision process, for example?
Yeah.
So I think central banks and financial regulation don't exist in a vacuum. As Nielsen has shown, there is a mandate in the Central Bank of Israel to take into account inequality. And if it's put like that, then that's a dimension that should enter the decision process and the choice at the end. Now, what is the best way for the central bank to give a weight or balance this, let's say, secondary objective compared to the financial stability objectives? That's a difficult question, and maybe they're including other stakeholders that have a better view or the consequence of inequality that can better reflect inequality concern, and mixing them with central bank views that could give a good ground for discussion. That being said, I think at the end the central bank and the financial regulator should keep let's say a large decision power inside this process, because they are at the end responsible for the other side of their mandate, and this should not be compromised.
Thanks.
If I could, Katja, just I think that Pierre made an important point here, which is that housing policies in general are so multifaceted. They involve so many different areas of government that it's important to look at the different stakeholders, to use your word, Pierre, that are and policymakers that are involved in this. Let me give you an example, just to make the point about the need for coherence and consistency, while bearing in mind the specific mandates and the functions of the different actors in this. But policies that are designed to free up supply, for instance, taken at the central government level, we'll need to bear in mind that a lot of the land use regulations are carried out at subnational levels of government. A lot of the policies related to zoning in our cities are carried out at the local level of government, and they are extremely important when it comes to creating conditions for supply to respond to demand, even in the level of cities. So we see around the world experiments in terms of policies that change regulations about, single-family dwellings as opposed to mixed-use buildings, and those policies are typically carried out not by the same people who will design other aspects of policy. So there is a need to seek coherence in a governance structure that is extremely decentralized. But all that bearing in mind that mandates differ, and that we need to be mindful of what each of those stakeholders can do best. And this is particularly important at the current situation, as we are emerging from this pandemic, and where demand is shifting and may be shifting in a durable manner, demand for housing, I'm saying, or for real estate in general. Nitzan mentioned in her presentation this, what she calls the leakage, right, towards demand shifting away from city centers. We are seeing a process where demand may be shifting away from city centers in a durable manner because of more widespread use of teleworking, everything that we know that is related to the pandemic. So evaluating policies at the current stage, where so many things are happening at the same time, is particularly complicated. And it is important for policymakers to take all those factors into account so that, one, we can have a better mapping of what's happening to demand, so that we know what and where and when supply needs to respond. Bear in mind that investment in housing has typically long maturities, and we are talking about locking in uses of capital for many years. So making sure that we reflect that in the way we are designing cities, the way we're thinking about regional development, the way we are thinking about stability of the macro system in general, it is a very complex task. So thinking of a comprehensive strategy for housing is a point we've been making that can help recognize the limitations of the different policy tools that we have, recognize what the different policy tools can do, recognize the trade-offs when they exist, but also make the most of complementarities in policy choices where they exist, because there are many as well that need to be understood.
Thanks. So Nizan, do you have any views about this?
Yeah, so follow up, Louise. Louise's comments, I can mention that, for instance, while when the Central Bank of Israel implemented those macroprudential policy tools, in the same time, the Ministry of Finance implemented a tax policy, lowered the tax on housing purchases, which increased the demand. And this is why it's very important to have a committee with all the regulators that can share ideas, data, views on this topic. In terms of the decision maker structure, I think that it's very important, and mentioned in my presentation, to keep the independence of the central bank, specifically in stabilize the financial system. One last point that I want to mention is, if we talk about inequality, I think that inequality, it's a very complicated term. I think that we should differ between income inequality and wealth inequality, and we should understand better how to measure inequality. And I think in terms of the literature, this is why we don't see a lot of evidence on the effect of macro on inequality, because inequality is a very complicated thing to measure, and again, data issues. Thank you.
Okay, I'm once again taking into account your latest sentence. So concerning the data, in order to evaluate the impact of the borrower-based tools and the effective borrower-based tools, so a lot of focus has been lately on the data and availability of data. So how do you see the data question? So what data should we increase in order to have more effective macro policies and policy framework? So who would like to begin? Luis.
Perhaps I can have a go, Katja. This is also a point we've been trying to make and working on for some time. I think what is extremely important to assess these particular instruments, but more broadly in housing policies, is one, a lot more granularity of information than we currently have on prices. We've done a lot of work on housing, on house prices, and computing national averages and so on. This is not enough. We need to have better information on house price growth and house price levels. We need to have better information of both at the very local level. A lot of the changes that we see in prices takes place even within cities, so we need to have much better information on that, much better information on quality adjusted prices, much more information on the types of housing units so that we can understand the demand better, much better information on how demand is shifting, so information at a very granular level on transactions that would allow us to see those shifts in demand as they take place, and shifts across borrowers as well, because without understanding the nature of who borrows, we will not have a full picture about demand. A lot more information about the type of investments that are being made to increase the supply of housing, for example. A lot more information on the variety of segments of the real estate market, especially if there is going to be a lot of shifts in demand for residential commercial use, for instance, in our economies, and in ways that information that we can build and that can be matched with the type of information that regulators and central banks have, so that we can then build this broader mapping of borrowers to where they live, the type of units they are looking for, where those units are, the volume of transactions, the type of actors in those market segments as well. A lot of work ahead of us.
Yep. Okay, so Pierre and Nizan.
Well, I don't have anything particularly to say on data. I'm not the specialist of that anyway. But what I might highlight is, we need data, but we need also good model in a sense if we want to really assess this effect, because I think it's also present in the question that we have asked. There are many channels through which borrower-based measure impact income and wealth inequality. I mean, they, for example, reduce prices, which make them more affordable for low income and low wealth houses. So it's a challenging task to model all these channels. One recommendation that I would have is, when we look at inequality, whether it is income or wealth inequality, and here we should look at several dimensions, not only one, is indicators like the Gini index are a good summary, but they don't give a super picture of the distribution. We should also have a closer look at the tail of the distribution, especially in the low income, low wealth part, because there you could have effects that don't reflect on central measure like the Gini index, but are very specific to low income, and that's actually where we have concern about inequality.
Okay, thanks. So Nizan?
Yes, I think that it's crucial to have better access to detailed level data in order to better understand the distributional effect of macroprudential policies. For instance, I think that we should understand the effect on other type of loans, not just mortgages, access to financial wealth. If we talk about inequality and wealth inequality, we should have access to not just income, not just housing wealth, but other financial wealth. Also, I think it's very important to understand the labor market. So to understand the effect of macroprudential policies on the labor market, we need better access, better data to information on the labor market. Another obstacle that we have in the Bank of Israel is access to rent data on the renting market. And another issue is about expectations. So we used to measure expectations on the housing market using surveys. I think that we should have better surveys of that measure expectations and beliefs about the housing market.
Okay, thanks. So I think that I'm afraid that we are running out of time, even though it would be very, very interesting to continue this discussion. But it's been an honor to have this discussion with you, and thanks for the organizers for organizing this excellent seminar. Thank you very much.
Thank you.
A great thanks to the presenters and especially to Ms. Taipalus for moderating this excellent panel. And before announcing the break, I would also like to remind our viewers that your opinion is really, really valuable to us. Therefore, we are kindly asking you to leave your comment and your opinion about this conference in the poll section, in the poll icon that can be found in the top bar of the chat function. And now I would like to announce a break, and I would like to welcome you back to the conference at 1:30 p.m. Vilnius time. So see you soon. Ladies and gentlemen, welcome back after the break. We have one last session ahead of us. It's a very interesting panel that will be focusing on the climate-related risks and the potential of borrower-based measures. Before starting the session, I would like to remind our viewers that you are able to ask questions in the comment box below this video translation, as well as leave your opinion about this conference in the polls icon that can be found on the top bar of the comment section. Before starting the panel, I must inform all the viewers that unfortunately, due to an emergency situation, one of the presenters, Ms. Sarina Grunewald, will not be able to present today, unfortunately. Let's begin the session, and I would like to introduce the first speaker of the panel, Mr. Paul Hibbert, who is the head of the Systemic Risk and Financial Institutions Division at the European Central Bank. In this role, Mr. Hibbert leads a systemic risk analysis that feeds into the ECB's flagship financial stability review. Mr. Hibbert's current role builds on over 20 years of experience in the European Central Bank, in the International Monetary Fund, the Reserve Bank of Australia, as well as the Canadian Department of Finance. Mr. Hibbert, it's my great pleasure to introduce you and welcome you here. Please, the floor is yours.
Thanks, Agne, and great to be here. I have to say, virtually, unfortunately, I've heard wonders about the Lithuanian pink soup that of years past of this conference, which is very, very popular. And of course, participants have raved about it. For now, I'm here in lowly Frankfurt, and the green sauce analog, which is the local cuisine here, may fit actually better in some ways with the climate motif of the panel discussion today. So what I plan to do is present some results of the work we've been doing and conducting here at the ECB, and as well as the European Systemic Risk Board on quantifying systemic risk. And we've really made a sort of concerted effort to endeavor to use supervisory data sets, link these up with climate data sets, and try to say some more about quantifying and providing evidence, because that evidence, in our view, should be the cornerstone of what underpins eventual policy. So you'll be seeing that I'll have the options as such on the macroprudential side, which is a bit nascent, I have to say. It's work that's very much ongoing and current. So I'm happy to share that with you today and get some feedback, of course, from the conference itself. Now, just before launching into this, of course, there is a disclaimer. Particularly the policy part is still just a work in progress and initial thinking. So with that in mind, these are my views. Now I'll switch to the next slide, skip there, and then we can get started. Exactly. So basically, in the outline, I want to, as I said, outline the growing body of evidence that the ECB and European Systemic Risk Board is gathering over the last couple of years. And I want to map those as best I can into some macroprudential policy reflections that's here specifically for the European Union. So you have a little bit of an echo, and I guess the colors kind of tell you this in the outline here, whereby I will basically have the evidence first, and I'll try and make use of that evidence and trying to outline some of the policy thinking that's currently underway here. What I can say, because I think, in advance of the panel, the chair, Thomas, had shared with us some questions about the suitability of macroprudential policy, is I think there is a role to play in addressing climate risk, but it's quite a specialized one. And you'll see through the slides that in principle, that role should be covering systemic risk aspects of climate change. In practice, of course, it's always a little bit more complicated, and I think it's a function of what do we mean by systemic risk angle and the basis of what available evidence, and hopefully that will come through by the end of the slides. So with that in mind, the 4 blocks that I have now in the evidence side are basically the following, and it's the ones here in green, and I'll start with this, is that basically climate shocks, I want to just draw out what the scientists are telling us. This is not obviously proprietary analysis, as we have few climate scientists on board here in our own institutions, but rather take stock of what's already out there in the climate literature. Next, I think what we want to do is think about financial markets and how their potential repricing might take place. Third is the idea about financial exposure, should that repricing take place. And to foreshadow the results, I'll say that repricing is definitely going to take place. It's a question of who will be exposed when it does. And the fourth will really be about taking this analysis forward. It's a long-term risk, and we need to have that perspective. So next slide, I'll start with the first block, which is taking stock of what we know about climate shocks. And I'd say the reading of the literature we have thus far is that climate shocks are not only likely, but they're actually inevitable. So whilst we all might have our own subjective discount rates and normative views about the veracity of the climate shock, what I can say is it generally is a misnomer to designate this shock as just a distant long-term risk. I would say near-term impacts are already here, and in fact, if anything, will only intensify with time. And let me just tell you about that in basically these two slides. These two charts basically talk about physical risk and transition risk. So on the left-hand side, it's really about this idea of physical risk manifestation, that it's not just a risk anymore. This is actually in the baseline. So the most recent report, just a month and a half ago, from the Intergovernmental Panel on Climate Change, which brings together a lot of climate scientists, is that we have 1.1 degree of centigrade warming already through anthropogenic, so human induced climate change already in the baseline. That's already occurred, and it's used up part of our carbon budget. So basically, we see the warmest temperatures we've had since the time of Christ, 2,000 years ago. And the unequivocal human impact is certainly there as a part of the IPCC. And they use actually quite strong language in this report, which suggests that this has become pretty much an industry dominant view. Now, what's interesting is on the right-hand side is to say, that physical risk is now basically being priced in. Does the climate scientists believe that this is occurring? And if anything, will intensify. And we're very close to this 1.5 degree Paris-aligned objective of global warming, and not that far from the 2 degree tipping point, which could be quite catastrophic in terms of creating a lot of nonlinear dynamics. Now, what's interesting on the transition risk side, on the right-hand side chart, is this idea that indeed climate is not a distant issue, but it's actually quite near term. Insofar as there's going to be a massive carbon adjustment that has to be made in terms of reducing carbon emissions, and not in the next decades, but actually in the next years, to bring this down to Paris-aligned levels. And that is going to mean that, what we've seen in terms of current pledges and targets, so in the Paris Agreement, this gray shaded area, is not a good guide. We're going to need something very sharp, something we've not seen yet, and probably not seen ever before in terms of tightening in that respect. So next slide is basically taking it forward. If climate shocks are not only likely but inevitable, what is the prospect of a financial market repricing once this becomes more salient? And what we can see here is that financial market capacity is building very, very rapidly. So financial markets, in theory, can help that transition. They can have a growth of supply of instruments to manage increasing demand. They can also help us with this management of orderly portfolio alignment in respect to this climate new normal. We hear new normal often with COVID, but there's going to be a climate new normal too. You'd want perhaps more complete markets with selection of risk management for all contingencies, in sort of Arrow de Brue style. Now, on the left-hand side, what we see chart here is that there's exponential growth in green financial instruments. So assets under management of ESG have tripled over the last, say, 6 or so years, an 8-fold increase in green bonds, catastrophe bonds around 2 times higher, and emissions derivatives around 7 times higher. So clearly, the markets are looking to harness growth opportunities like ESG or bonds. It's a bit less about risk management products thus far. Derivatives, you can see that the actual outstanding amount is very low, according to these bars on the right part of that left-hand side chart. So clearly, there's a lot more adjustments going to be needed, and the financial markets will play an integral part. The right-hand side chart, I think, is really a quite interesting one from our colleagues at ESMA, which is that the investment portfolios of European Union asset managers are still very heavily tilted towards high-emitting firms. So what you see is around 55% of exposures at the moment of investment funds that are high-emission brown firms, and only around 1% of those are actually taxonomy aligned. So with that in mind, we do have the concern that financial market repricing could be quite abrupt and not an orderly one, as this potential portfolio adjustment is brought forward and done in a way which is very sudden. Now, this next slide is basically telling us that markets, while they're still growing, they're very much still incomplete, and I'd say informationally inefficient. And what do I mean by that? Well, you kind of have allocated market failures, so the pricing of externalities, but it's this informational market failures, so the inability to price, which is an issue. And the IMF just yesterday published a piece about greenwashing, which is a major issue in green markets. Now, financial markets, I'd argue in this respect, is the headline of the slide would say, are incomplete, inconsistent, and insufficient. What do I mean by that? Incomplete insofar as there's still voluntary standards on disclosures and reporting, and that reporting is therefore patchy and you'd argue even subject to selection bias. This inconsistent part is this idea about an inability to have an accepted methodology in defining green or brown assets. So standards, validation, these things are lacking. Insufficient insofar as you have basically an inability to have this reporting on a consistent basis and therefore aggregate any exposures into a portfolio consideration. And that right-hand side chart is really about this. So it's this idea that banks also have the scopes of emissions, so what they directly produce, the indirect inputs into what they're producing, and the downstream emissions of their lending portfolios or their securities portfolios actually have a carbon intensity associated with them, and those tend not to be reported, and it's almost impossible at the moment to do so because the reporting is so patchy. There are a lot of initiatives underway, and this should improve, but for now that is going to be a major concern. So one takeaway is markets are willing to price, perhaps, but they're unable to do so in a way which is efficient thus far. Next slide gives us a bit of a detour away from this idea that climate shocks are going to occur, financial markets are going to reprice. Then what would you have in terms of the financial exposures? I think this is where we start to get closer to policy. What can we do to insulate and work with our financial institutions to ensure that they're part of this green transition? So I'll start on the side of physical risk of climate change, and I'll turn to transition risk in a few slides. So on the side of physical risk, what we see, I think, first big message is regional concentrations of exposures. So here we've taken around 1.5 million euro area firms to 6 physical risk hazards. Now, what I can say is that basically on the left-hand side chart is you have this very granular topology of exposures. So millions of firms' susceptibility to climate risk, each is a dot in this map of Europe. And you can see the spatial variation of this climatological hazards quite clearly here in terms of high or increasing sort of exposure to climatological hazards. The middle just puts this in a bit more of a bite-sized format where you can say, well, what proportion of firms in a given country are actually subject to these climatological hazards? And that proportion is a y-axis. The x-axis gives you the 6 hazards we're looking at. And what you can see is that basically floods are the most economically widespread one. You get a little bit more orange that's more widespread across countries, whereas region-specific issues like wildfires, heat, water stress, the last 3 columns, tend to be quite prominent in some jurisdictions, in the Mediterranean basin mainly. Now, what it means in terms of the right-hand side, where we take all of this and map it onto credit through credit registers and credit data, is that we see that there you have around 30%, so there's orange and red part of the right-hand side chart, the furthest right-hand bar, are actually in higher increasing climate risk. So should we see, as I already foreshadowed, that we're going to have increasing intensity of physical risk, it looks like a coalescing of these natural hazards could actually cause 30% or so of the banking sector assets in the euro area to be at risk. Next slide basically tells us about the idea that it's not just concentrated to regions, but also specific banks. Banks in terms of the left-hand side chart, which are more weakly capitalized, so this yellow box plot, where you see that exposures are around 6 times larger for the banks which have lower capitalization, or profitability, which is the blue part of the box plot, which is around 2.5 times more likely that you have the least profitable banks being faced with physical risk. The right-hand side is really just saying actually within specific banks, the top 25 banks of exposures, they have around 70% of these exposures. So 70% of exposures to physical risk concentrated in only 25 banks. So there is a concern that it's concentrated again on the physical risk side, regions and banks. Next slide just tells us a bit about mitigants. And of course, when we're thinking about loss given default, which will obviously be something in the policy space we're interested in understanding through expected losses, it's this idea that collateral and insurance might actually, we would think, provide some solace, but they unfortunately don't in the case of systemic losses. Left-hand side is about this idea you could have wrong way risk, whereby the collateral being provided often itself could be at risk of physical risk hazards at the exact same time as the firm is struggling to meet its obligations given physical damage. Manufacturing, real estate, for instance, are some of the areas we'd be concerned about in terms of the sectoral breakdown. The right-hand side chart, even more interestingly, is this, insurers are very good at pricing systematic risk, that is diversifiable risk. But of course, there's the issue in terms of systemic risk. It's not diversifiable. And there we could see that coverage might be an issue. Now, even before we get to that systemic tipping point, what we see is only around 1/3 of climate, economically relevant climate losses are actually insured. So that means that the majority of climate, economically relevant climate shocks are actually uninsured, therefore leaving a prospective insurance gap. So the losses given any potential physical risk manifestation could be large. Next slide, turning over to transition risk. So this slide is about basically the exposures in terms of concentrations, I'd say across economic sectors and within economic sectors. I think this is going to be a major concern for us here, is the idea that banks' emission scopes suggest that manufacturing portfolios could see a lot of scope 3 emissions, so downstream emissions intensities. Think diesel cars, for instance, in here. Whereas, mining, electricity, and gas tend to be thought of as particularly prone to climate risk. Well, they're actually not a big part of banks' loan exposures, only about 5% versus the 20% of loan exposures of euro area banks in manufacturing. So clearly, if we have a holistic look at the portfolios across sectors and we think about all scopes of emission intensity, we might give us rise to some concern that some losses could be inherent here and some protection would need to be taken against probabilities of this arising. Right-hand side chart just tells us a little bit that the sectoral designation of a firm does endow the firm with some climate risk, but in fact, a lot of it is within sector variation. So firms can be very efficient or can be very inefficient in their climate technologies even within economic sectors. And credit rating agencies surely will take notice of this and penalize those firms which are most inefficient in a cross-sectional sense. The next slide is just going to this fourth and last block, is taking all of this forward. What we want to do is actually take a holistic look at physical risk and transition risk, not in isolation, but examine trade-offs between the two. And there you certainly need to extend out the horizon. So what we see is these long-term scenarios where we have policy assumptions about median temperature rises and also carbon dioxide removal technologies, that you'd have an orderly transition scenario where things go quite well. The Paris alignment is achieved through minimal disruption. You have a disorderly transition where the transition risks become dominant, and then you have a hothouse world where the physical risks become dominant. Or basically the two latter ones are going to be sort of akin to adverse scenarios in the way we think of them in a stress test. And if you skip to the next slide, what we see of these long-term scenarios is certainly a high degree of path dependence. So on the sectoral side, these diamonds in the left-hand side chart tell us that the highest emitting firms are going to be the ones certainly subject to the most sort of extreme increase in the probabilities of default over the life of this 30-year time horizon scenario. And on the right-hand side chart, what's interesting is that whereas transition risk will be quite dominant over the next, say, 10 to 13 years, physical risk will take over and only rise thereafter. So the question of discounting a horizon becomes very important. And of course, as I turn to the policy side, one has to think about the idea that supervisors in the prudential framework is generally geared towards a 3 to 5 year maximum horizon, not 30 years. So it's going to require a bit of retooling. Next slide, which is going to be effectively getting to the end of my elucidation of evidence, and I turn quickly to policy, is this idea that we can run these scenarios consistently for banks, insurers, and investment funds. Banks, of course, credit risk we're probably quite interested in, and insurers, investment funds, mainly about market risk on the asset side. You can think about other risks. Insurers are quite good at managing the liability risk, but for now, that's what we've looked at. And the next slide just gives you a summary of all of the evidence I've presented. And I want to now, before turning to the policy side, just mention both systemic risk perspectives map into these two findings, i.e., the first in this chart, or excuse me, this slide, is that it's in the cross section. What do we see? Just repeating what I've already told you, is this idea that we have concentrations of risk, geographies, sectors, firms, depending on how you're looking at it. The second bullet is this idea in blue of the time dimension of systemic risk. Risks are path dependent, and we're going to see them materializing in such a way. So far, we have accounting shocks, more or less in terms of exposures. With time, we're going to have dynamic overlay and think about systemic shocks. Now, with all this in mind, I shift in the next slide to the macroprudential policy reflections. And this is, I think, now taking all of that evidence, what can I say? And here,
unfortunately, we are experiencing some technical issues. We should resume shortly.
Sorry about the technical glitch. I seem to be back. I don't know exactly what happened there. So effectively, if we can move forward one slide. Yeah, so complex, we basically have complex and complicated climate risk in terms of the measurement, and I've already detailed this in terms of implementation. Next slide is just going to tell us, as we move along, the question is, the first question for us in considering a policy space, is the Basel framework fit for purpose? And I'd say in general it is, and this is where I've highlighted, there's a report here, this is a complicated infographic, but just to say on the right-hand side, it gives us basically the 5 areas we would consider potentially relevant in terms of risk. And they're familiar categories: credit risk first. This idea you could have income effects in terms of ability to repay, or recover the value in terms of wealth effects. Certainly climate, from what I've told you so far, could fit neatly in here. Second is about market risk, this idea about sudden asset price corrections or breakdowns and correlations. Again, you could imagine that could be consistent with the evidence I've shown. Third, about liquidity risk, this idea that you could have potential destabilizing funding, should there be sort of panics or risks, again an issue. Fourth is about operational risk, so legal and regulatory compliance risk. And fifth is about reputational, perhaps not so well captured in terms of the measurement we have, but it is something which could impact firms. So I'll go to the next slide and just say only one word on this slide, which is the idea in terms of measurement. Again, from a Basel report, you see the reference here, and I've included all the references at the end. It is this idea that much of the evidence I've shown you is about firms, not households, not sovereigns. So firms is where we have the best available evidence thus far. And arguably, when I come around to borrower-based requirements, it could be a challenge to have this idea about system-wide losses. Next slide. It's just thinking about the macroprudential overlay now. So of course, you have the ex-ante and ex-post parts of macroprudential. And this has been discussed at length in previous panels of this very interesting conference. Now, I think what's important to say in terms of the ex-ante, the risk build-up phase versus the risk materialization phase, ex-post, is in this build-up phase, we know we have relatively short-term business cycles, say the size of a, say, political cycle, 4 to 5 years maybe on average, whereas you have around 7 to 12 years financial cycle duration. And of course, climate is we're talking about up to 10, up to 50 years of a secular trend, not really a cycle per se. So it's interesting to mix these different frequencies together. And that's something we're obviously in this temporal dichotomy stuck with. I still think you can think about it in a systemic risk paradigm in terms of the following. You can have, macroprudential policy both being effective and suitable to build up, to counter this idea of risk buildup in a preventative phase. So that could be credit that's allocated towards green or non-green questions, asset prices as such, and how they're treated in the prudential framework. Now, recalling this idea of risk concentrations and path dependence I mentioned would suggest that that could be an effective tool as we move forward. Now, ex post, of course, is this idea about materialization of credit and credit losses should they occur. And I think this idea is that indeed the time profile might be difficult to capture, but nevertheless, this idea that capital could provide, or concentration or other elements could provide some elements of solace. Now, I'll go to the next slide to give you a bit more meat around this bone. And it's the idea that if you zero in on the macroprudential instruments available within Europe, basically what you have is the following. 4 different categories. And now I've listed them here by instrument type on the left-hand side and by legal act on the top. And I want to basically talk about 3 different blocks. The first is capital-based measures. Now, a lot of discussion is about these. Legal acts that basically give us this ability to set buffers or have sort of minimum requirements. Now, the idea is here, of course, you could imagine this idea that you have some buffers which are both time-varying or also insulate firms in terms of robustness in all states of nature. And there's this idea about resilience and robustness we probably want to bake into the framework when we're thinking about climate. That is resilience to unforeseeable green swan type events, robustness to ones we know are coming. So what's clear is that you would have this issue of capital being potentially an option, but it's very difficult with the look forward horizon of maybe decades long occurrence of risk and a changing mix of transition physical depending on how things are evolving. To think about that is a particularly easy to use one as yet, but I think it's still not one we would throw in the baby with the bathwater. It still could be that still does provide some degree of resilience and robustness. The next block, which is you're reading down from the top, is this idea about borrower-based measures. And indeed, this is something been discussed at length in this conference. Very interesting points made. Is of course there the difficulty is they're predominantly household oriented. Now you could think about household mortgages being one of the elements we could consider. Much of the evidence we have collected thus far was about firms. So would you have it in terms of the emissions intensity of firms, the greenness of what they're doing, it is an option. Of course, it's quite political, and the difficulty is this distributional aspects, like anything else. And fossil fuel energy sources, I think we heard in a previous panel, are generally an issue that is not uncorrelated, let's say, with income inequality or wealth inequality. So it's clearly one you'd have to do very carefully. I think the other measures block, the third block here in yellow, is perhaps the most interesting one to analyze, and there's two that I'd highlight. So the first is this idea about concentration charges or large exposure limits, and that could be imposed depending on the emissions intensity of a counterparty or physical risk intensity. So indeed, a lot of what I showed you was concentration. Thus far, in terms of the risks we can believe we can measure quite well. So clearly, that's one of the macroprudential tools we might consider. The other, of course, is disclosures. Disclosures is a key one, and maybe flip to the next slide to talk about that. So the next slide, which is my last slide before the conclusions, is just to say the Financial Stability Board has put a lot of its emphasis on disclosures. So disclosures for climate is going to get around these informational inefficiencies I mentioned at the outset and help markets more efficiently find solutions, price, in terms of data and disclosures. The allocative efficiencies arguably are not divorced from this and would follow. And indeed, you need a system-wide perspective to ensure this is not passed around like a hot potato, either proverbially or in the world of climate, perhaps even literally. So this idea of the FSB, we're working together with them, of course, this idea about disclosures, data, and then to map onto this more about vulnerabilities analysis, forward-looking elements, and from that we can come up with some sense of what might constitute the way forward. The last slide is just going to give you the summary. And basically, it's this idea about the evidence. I detailed that already. And just to mention the macroprudential points. So the Basel framework, I'd argue, is actually quite suitable. Most of the climate-related risks could fit into that framework. Second point, macroprudential considerations. It's complex and complicated, but not intractable. And you could imagine climate feeding into the ex-ante or ex-post phases of macroprudential policy. Third is a question about banks. So among the EU macroprudential instruments, some, like risk exposures questions, disclosures could be quite powerful. You might also have some potential for capital liquidity and other potential instruments, including borrower-based measures. And fourth, this idea about beyond banks, where we have to think really about this informational inefficiencies tackling with data disclosures, and then going through with the amplifiers and cross-system interactions. This is truly a risk across financial institutions, across geographies, which we have to have a concerted approach. So with that, thanks for your attention. I'll pass back to the organizers and happy to take questions in the Q&A. Thanks.
Dear Paul, thank you very much for your excellent presentation, as always. I would now like to invite and introduce the second panelist, Mr. Stijn Claessens, who is the head of Financial Stability Policy Division and the deputy head of the Monetary and Economic Department at the Bank for International Settlements. Mr. Claessens represents the BIS externally in senior groups, including the Financial Stability Board, G20, or the Basel Committee on Banking Supervision. For many years, until 2006, Mr. Claessens worked at the World Bank. From 2007 to 2014, Mr. Claessens was part of the International Monetary Fund, working as an assistant director of the research department. And then until 2017, Mr. Claessens was also a senior advisor in the Division of International Finance of the Federal Reserve Board. So it's my great honor and pleasure to have you here with us today, Mr. Claessens. Please, the floor is yours.
Thanks very much, Agne. It's a pleasure, although I can only be here virtually with you, all of you, to be at this conference. It's a very good initiative, and I'm very happy to speak on this topic. I must say that Paul gave a very good introduction and covered many of the bases of the issue on climate-related risk and the role of borrower-based measures. So in my outline, I will try to follow a little closer the questions that were being asked of this panel. And you see on the slide here the three questions that we were asked to answer. Should macroprudential policy be used to address the risk arising from climate change? What are its relative pros and cons compared to other economic policies? And particularly, what's the potential role of borrower-based measures? So in my presentation, and here's the outline, I'll try to cover those. I'll start with what are the climate change related risks exactly. And here Paul really did a great job in alluding us to all of these risks, both economic, of course, which we know very well are facing us even today, but also the financial stability risks. I would add here one element that's important. I want to speak at the very end about it, the contribution of the financial system to tackling the climate change challenge. So really the issue of how we can overcome the problem in the first place. The focus, because we have talked about macroprudential policies, of course, is on financial stability, but also these financing needs. I do want to do a little bit of looking back on what the goal of macroprudential policies are in the first place. I'm calling them MAPs. And what are the potential systemic financial stability risks? And I think it's important here to go back a little bit to the principles, because there's many tools central banks and other regulatory agencies could use, but we do want to have them both consistent with their mandate, but also consistent with the economics that we're trying to pursue in the first place. What policy works for what? This is the old Tinbergen principle, use efficient and effective policies. And talk a little bit about the trade-offs. There are quite a few that you will come across as you use these policies. And then we're going to get into the specific borrow-based measures and the potential role of those. So with that, first the climate risk, as noted, well covered in Paul's presentation. The physical risk and the transition risk are the two that we typically distinguish, of course. I would want to start by saying that physical risk is not necessarily new, and I'm here particularly looking for the insurance industry as being the in part of the financial sector that's managed those risks for a long time, of course. Think of hurricanes and other kind of insurance. They really have to think long term of how to manage these once in a lifetime, but of course these days not anymore once in a lifetime. The banking system is different. It's part because it has short maturity, it has a little bit more time to get ready for it. So they don't keep the loans on their books forever. And that also means that those risks, which are going to materialize over a longer period of time, can be managed by not even engaging in certain activities. Nevertheless, we have to acknowledge, as Paul said, that these risks are increasing. We have many more unexpected events. We should also acknowledge the unknowns. These risks can be large, particularly for some countries. They can come very suddenly. There is a lot of potential for tipping risks here. We also have to realize that governments may have to step in. This is not something that can be only left to the financial sector, not just only in terms of the policies, let's say in the carbon taxation, mitigation, adaptation, etc., but also in terms of what might happen if the financial sector were to be hit by a particular crisis. And we've had the pandemic, of course, where we had, in some sense, a natural experiment of a large risk coming to the economy, and the government really had to step in a lot, as did central banks. Nevertheless, to the extent we can anticipate, which with the climate change we should have tried to avoid these systemic risks, even on the physical side. That's even more so when we talk about transition risk. Transition risk, defined here very briefly, arising from both market and policy actions. The policy actions are obvious. When do governments take the actions from which then the market will respond? But we may also see some problems in the market themselves, but they may not be coordinating perfectly among each other, and we can get some problems there, some policy failures as well as market failures can, in other words, arise. And particularly when I think globally, which we should, of course, in this case, there's a lot of scope for lack of coordination, which then means that the financial system has more risks, or it could even mean that the financial system is going to be asked to do more, which is not exactly what we like to think of, but nevertheless is a potential possibility as well. And again, Paul has laid out these risks in a quantitative way very well for the European part of the financial system. So I'll be brief and leave it to this, and really get to the more macroprudential policy part. First, speaking in general on macroprudential policies, and then a little bit more specific on how we may be able to adapt them to the climate change risks. I'm going to talk mostly about cyclical risk, meaning those that arise over the cycle. This is where macroprudential policies have been used quite a bit, but there's also the cross-sectional part of it, the large financial institutions that may create risk for other institutions. This is the systemic banks, so the systemic insurance companies, systemic financial market utilities like central clearing and counterparties and settlement systems. But that part I leave a little bit more aside because in some sense it's easier. It applies in many ways to this issue as well. Now, first, from a general principle point of view, this is kind of a schematic way of thinking about macroprudential, because what macroprudential tries to do is to acknowledge this endogenous risk that's being built up over a particular time. You can kind of think of risks in two ways. And in some sense, the pandemic is one form, and then the macroprudential is another form. If you take the left-hand panel here, this is more the pandemic version of risk. We have an expansion, risk is low, but suddenly there's a shock. That can be this pandemic shock, but there are many other, of course, an oil price shock, what have you. And during that period when the shock occurs, at least the view was that risk is then high. We have a contraction in economic activity. The financial system is under stress in terms of potentially non-performing loans or other more liquidity issues. And then it recovers over time back to its long-run state of affairs. But there is this counter view that in some sense is macroprudential on the cyclical side, is trying to reduce the risk buildup in the time of the expansion. So risk is not necessarily low, it's actually increasing during this buildup period. And then when there is a trigger, which can be many triggers, it doesn't have to be even a large shock, it can be a small shock, that nevertheless makes the risk materialize. And at that point, we're facing a contraction both on the real side, but also the financial system is in stress. Now that's a very different view in the sense you can also already see where the risks are high versus low. And it also means that the macroprudential policies that we want to use is really trying to reduce the buildup of risk, the vulnerabilities in the expansion phase, because it matters a lot for then the approaches that one takes to reducing these risks. And the way we like to phrase it here at the BAS is you really want to develop a macrofinancial stability framework. So not only thinking of the macroprudential policies, which is only one block in this larger scheme of potential policies to achieve macrofinancial stability, but you want to think of them together with microprudential policies, so on the prudential side, but you also want to think it together with the macro policies, the monetary, fiscal, as well as with the structural policy. So the combined package is important here. And the macroprudential is just one tool to achieve that. And Paul already mentioned, for example, Basel and Basel III, that microprudential policy framework that we now have, which we, of course, we built up after the global financial crisis, is one that really acknowledges risks, including climate risk, as being one to manage. In that sense, the Basel III framework is fit for tackling this risk, not in all dimensions, but in many respects, it is able to do so. So then the question for the macroprudential is really what is there the specific cyclical and large systemic risks that it may want to address in this context. Well, then we go back to the distinction of physical and transition risks that I mentioned before. These could be large, and as I mentioned, clearly there are many unknowns. Now that's not the only risk that is an unknown, and there are cyber risks, there are operational risks, so in some sense climate falls within this category in terms of its evolution and potential impact on the financial system. The transition risk, as I mentioned, may be the bigger one, and there that could go maybe even quicker, maybe too quick for that matter, than we really would want on the economic side. So there is a lot of scope for stranded assets, for example, of brown assets that are suddenly economically no longer viable. Now, what is the response here? Well, I would say foremost, not necessarily on the macroprudential side, but more thinking systemic in the first place. So think of the system, how it's conducting under stress. And this is not only done by stress tests, which are based on historical data. In this case, we really need to use scenarios to be able to analyze the potential risks coming to the financial sector. And we need to do, as we have done in other contexts already, and we've seen the benefits, build in these buffers. One big lessons from this financial crisis that we just went through, from this economic crisis, the pandemic, was that we had a banking system that was well capitalized, had ample liquidity, that was able to deal with this large shock and actually be part of the solution for this particular crisis. And then the pandemic came out of the blue. The climate change is not coming out of the blue, but some of the shocks may come unexpectedly. And then within that context, once we have done these buffers and scenarios building beforehand, we can think whether there are any particular reasons why there isn't a source of externality. And this is where macroprudential becomes important, because we then have to go beyond the macroprudential to look at these issues of contagion or too big to fail in a cross-sectional context. But then in a cyclical context, we have to think of risk that will be building up over the cycle, which can be a very long one, or over the medium term. Two that I would want to highlight here that I think we see some imminent signs of. One is the green bubble. We have an environment today where there is a low interest rate. There is already much search for yield. And in that context, it's of course tempting for the financial sector to collectively maybe invest too much in the new green activities, which we would want, but we don't want them to be too rapid, so people will be disappointed. So this is also a call on not to ask to have the financial system do too much. It has to be consistent with the overall real economy, of course, that the transition is there in the first place. And similarly on the brown run, this is kind of the opposite, of course. We already see some of that, and maybe even today, as investments are not necessarily being made in energy and otherwise, that can have adverse real consequences. Now, to some extent, we want the adjustment, that's obvious, but we don't want it necessarily too fast and too quick. And this can create a brown run in which there's no financing for particular energy activities, for example, that we need. So we have to be careful that we balance the path for transition well. What does it mean for macroprudential policies now? It's not obvious, at least not so into my mind. The risks as is, physical and transition, may not yet be systemic. I mean, the numbers that Paul presented suggest here and there is some concentration, but it's not an overwhelming issue as of yet. I would, as I mentioned, be maybe worried a little bit about the bubbles and runs. There is an argument to be forward-looking and not to wait too long to put in place proper policies, and that could include macroprudential policies, but it doesn't have to be the only one. Now this is, of course, a tricky balancing act in the sense we can go against other policies that encourage green investments and green financing. So we would have to balance these macroprudential policies very, very carefully. And then, of course, there is the potential for unknown events to happen. As developments occur and risks materialize, there's no doubt that we'll have to adjust our policies as events happen. That's very clear on the monetary policy side. Prices do adjust and will adjust. They should adjust. So we're going to see some price changes going forward where monetary policy has to respond to. It's not different than we're experiencing today, where relative prices are also quite volatile as we restart the economy. But we also have to see how the real interest rates will have to respond, as these investments needs are very large to them. Meet the demands for the climate adaptation and mitigation. But here I think all of it is a word of caution is not to do too much, because the risk to the central banks or the supervisory agency is a risk to credibility. It's not obvious that they can, even at the margin, do sufficient to reduce these risks. So let me then end specifically on the borrower-based macroprudential policies for climate risks. What is the scope for that, and what can we do in this respect? I would have wanted and agree very much here, and I think Serenia was going to be saying the same thing, so she would have been here. The borrower-based are the most sensible because we really, on the cyclical side, we want to reduce the risk where it's coming from, which is on the borrower side, and that's the source of the climate concerns. There's also, of course, some risk with the financial institutions, but I would put it more in the category of the large exposure limits, maybe some other cyclical, surcharges for systemic size. But those are probably less important than doing those more borrower-based activities. But the problem here is that the macroprudential toolkit that we have is really targeting, of course, financial variables. It's not directly aimed at targeting climate risk. So in housing finance, we use the LTVs and the DTIs that you've been discussing. And there's a clear link between leverage and financial stability or instability. But if the target is climate, it's not obvious how to link that to the financial variables. So if there was a close correlation between highly leveraged and more climate risk, one could do that, but that's a priori not clear. And then one could create many unwanted side effects that you target some that looks like a correlation, but in the end, because of regulatory arbitrage and other side effects, we actually have this effect that we really don't want to pursue in the first place. So it's not so easy. And there are other concerns as well, and I think Paul mentioned them as well. Macroprudential policies, particularly when it comes to affecting households, borrower-based measures often do households. They can have a lot of impact on inequality and distribution when first-time home buyers can't buy a house. So in that sense, it's a tricky set of policies to use for this as well. That doesn't mean, as my last slide, I don't want to here say that we should not do much in the financial sector. I think we need to do a lot to help the transition and reduce climate risk. So there are many other actions that are needed and necessary. We know there's much financing needed for transition, for sustainable transition. That can be done by the public side, but it has to be done a lot also by the private side. And here the financial markets are key, obviously. They need to allocate and reallocate resources, and they don't have necessarily the proper infrastructure yet. So it's not clear what green financing exactly is compared to brown. The standards are relatively poor in the sense they're not common. So we need better taxonomies. We need greater disclosure of both environmental performance, so outcomes, but also plans. What are the emissions targets and the plans accordingly at the firm level? And we need the risks that come along with that in various dimensions. We need them in many ways, both individual, project, firm, and other levels, but also at the aggregate level, so that the market knows as a whole where countries or the economy as large is going for. Taxonomies and standards are one thing, but we need the infrastructure as well to support that. So rating agencies that do this now at the moment need to be developed to support this new activity in a sustainable, in the right manner. So here speed is important too. So we would want these standards to be there, but they cannot be too tough and too limited. So there's an optimal path for the standards as well, so that we encourage the right transition to this important issue. So let me stop here, and I'm looking forward as well to questions. So back to you.
Mr. Claessens, thank you very much for an excellent presentation. As mentioned earlier, due to unforeseen reasons, Ms. Raina Grunewald is not able to join us today and give her presentation. Therefore, I would like to open the panel discussion and introduce the moderator, Mr. Tomas Garbaravicius, who is an advisor to the Deputy Governor of the Bank of Lithuania. As in his previous role of the member of the board of the Bank of Lithuania, Mr. Garbaravicius is responsible and working in the areas of financial stability and macroprudential policy, climate change, and investment of reserves. Mr. Garbaravicius also co-chairs the ECB and ESRB working groups on macroprudential policy. And before that, for almost 10 years, he also worked at the European Central Bank in the DG Macroprudential Policy and Financial Stability. It's my great pleasure to invite Thomas. Thomas, please, the floor is yours.
Thank you. Thank you. Good afternoon, everybody. Welcome to Vilnius, this time virtually. So Paul will have to postpone Pink Soup until the next time. But nevertheless, first of all, let me thank to our speakers. The third speaker, unfortunately, due to emergency, could not join us this time. But nevertheless, we have a very interesting session about this cross-cutting climate change risk issue. And the topic is new, especially for macroprudential policy, but macroprudential policy itself is a rather recent thing. And I would say, as expected from two very interesting presentations, my sense is that both speakers coming from international institutions and speakers from international institutions tend to have very polished views in a way. So in my role as a moderator, I'll try to be more provocative in this case. And especially since we all saw the slides of Raina, who's from academia, of course, and she was in favor of more proactive role for macroprudential policy. So my first question would be, so both you kind of allowed the possibility for macroprudential policy to be used, but in very cautious ways. So my question would be, suppose we're in a situation where every policy, economic policy, has been asked to take whatever action it could take. Your preferred choice in the case of macroprudential policy, what would you do in particular? Maybe let's start from Paul. Paul, please.
That's a very good question, and a nice provocative one at that. So let's say, look, initially I like the idea that you're linking it as a part of a concerted policy approach, because I think Stein also made the point, and we've made the point through our ECB president a lot, that it is a complex problem, the climate issue in its origination, and to address it you need actually concerted policy, and there will be interactions. And much like the pandemic, we saw interactions between fiscal policy providing support, furlough schemes, or through to other elements, moratoria, for monetary and vice versa, which I think created a very powerful impetus. Now for climate, arguably, we need something similar. So back to your provocative question, Thomas. I think what's key here, and this is where I think the International Institute on Finance had quite an interesting piece about climate, where they talked about the difference between macroprudential policy, which is going to be just about climate shocks are occurring, and they hit the financial institutions as if they're an exogenous shock. But the macroprudential perspective they claim, and I think rightly so, it will involve this dual materiality, and Stein touched upon this too. This idea that the lending that's going into the climate situation via financial institutions obviously means that that's quite an endogenous shock. The evolution of global temperatures, carbon emissions will follow from this. Now I think that step I can understand, and it's a bit of a difficult one to tackle, and we're going to have to deal with the fact that there are limits to this dual materiality, because a third bucket that they offer after micro and macroprudential is this idea of active transition, where you start to actually have industrial policies creeping into what is arguably a financial risk management framework. So with this in mind, I think that third bucket they rule out, and quite frankly, I would too, noting that the idea that Stein had mentioned about Tinbergen, policy specialization, not overburdening instruments, should certainly be there. So if, to your question, Thomas, we saw that there was an actual credible plan for policies to impose some form of taxation framework on carbon. There were the technological side. We were seeing also carbon removal technologies also at play, and financial markets were adapting all in a way which is informationally efficient. You could then have a macroprudential policy response, which is predominantly about ensuring that banks, through the build-up phase of the risk, in the financial cycle are not lending into areas which might potentially be stranded or face potential difficulties. At the same time, you might want to have this resilience in place there, but the robustness in the form of a framework which allows you to absorb losses when they can and surely inevitably will occur, even during the most orderly of transitions, because this is a highly distributional shock across sectors, across geographies, and across even the firms within sectors, as I've mentioned. So with all this in mind, I think the macroprudential framework in an ideal setting, conditional on all other policies being in place in the most efficient way, would certainly be focused on both dimensions of systemic risk, and presumably with an angle to, over a decent time horizon, which is not too forward-looking, the financial institutions could manage that risk in a way which also has this endogenous reaction of their lending into the economy, considered as well as the impacts of climate directly on the bank. So with that in mind, I think the instruments you'd select in that respect, again, I'd hinted at this, concentration limits, concentration charges, might be one of the things you consider. I think to make the leap to capital, we just have to see, in effect, how material are these losses and over what horizon.
Okay, thank you, Paul. Stijn, what's your opinion?
It's easy to describe an ideal world, but unfortunately we don't necessarily live in that. So, I mean, if you ask the question the way you did it, whatever it could take, then of course central banks, regulatory agencies will do whatever it will take. I mean, this is too big an issue that we shouldn't put ourselves to our best foot here forward. But short of that, and this is really we're putting the ball back towards the governments, and the governments have to act globally in this respect. We need really a path where the private sector, financial markets including, can act accordingly that is consistent. And I think without that, it's very hard to do this planning, because if we're going to get the political reactions in a very haphazard way, we're going to be creating a lot of endogenous risks that we can't afford, and we shouldn't look for that. So now that's reality is more like that, I suspect. So then I would say in the first instance is building the resilience and robustness for these unexpected shocks that can come both from the real side, but I think importantly also from the policy side, where we would want to protect the financial system for. And I think I'm very much here interpreting macroprudential as having a systemic view in the first place. It's not so much a toolkit, and that applies whether you talk about housing finance or other risk. It's the perspective that's important, that gets us 90% or 80% towards what we want to achieve, is that we organize our thinking, the data, our analysis, our communications, our financial stability reports. So in that, I think we've made great progress in the central bank community and more generally among the regulators, so the NGVs and others. So building on that, I think we're doing a big part already. And then it's within that, and I very much agree with what Paul says, within that we can then pick our particular macroprudential toolkit that at the margin, which is really going to be at the margin, I suspect, make a difference in terms of concentration risks. Maybe there's something there to be done on the border. I already mentioned that I was skeptical. It's not so easy to do these things without regulatory arbitrage, but maybe there can be something can be done there as well. But let's first of all press on communication. Let's help on analysis. I think there's a lot of firepower, intellectual firepower among many of these agencies that can help governments that maybe are aware of the problem but don't necessarily have the economic toolkits in place to do and think about those. And hopefully that will be our biggest contribution in the short run, while we wait for the governments to put in place the policy paths going forward.
Thank you, Stijn. So the way it sounded that the focus, you would prefer to focus on resilience part rather than moderation of a cycle. Of course, we could have a discussion that whether there is a green cycle. We don't know yet. There might be a few sub-cycles during our future years, but in theory, theoretically, it's climate change is one-directional risk. We know it's coming, it's going, but how it's going to happen, we still don't know. Because I would say that borrow-based measures are more, or perceived actually in academia, from academic papers as well, are better suitable for credit management purposes. And in this case, with borrow-based measures, one could say, and actually here in Lithuania we received a few times requests, maybe we could use borrow-based measures, in particular loan-to-value ratios, to encourage green mortgages, for example. And in some cases, this is already happening in the market, because banks are applying softer LTV limits for mortgages if collateral is actually energy efficient. So what's your view about this particular proposal, if you were to support, if you were against, if you see risks of this particular approach? Please, maybe Stein, please.
I would start with the premise that a lot of this is microprudential. So indeed, if we discover that the green house, the green mortgage is less risky for a variety of reasons, including that the price adjustment will be upward rather than downward, then the microprudential action would be there, right? Both the bank or whoever else is the lender would have to adjust the risk weight accordingly, and they're free to do so within the current structure. Now, is there an additional question to encourage it? I mean, I typically tend to be of the view that we should discourage the bad behavior, and encourage the good behavior is not often as necessary as discouraging the bad behavior. So there may be something where the market is not realizing the potential risk to let's say the brown mortgage, and that we have a penalty in that respect, because the collective pressure on house prices coming from this is maybe a little bit higher. Maybe there's an argument, but it quantitatively rises to the level that we can adjust a mortgage rate for that over a short period. I'm skeptical. I mean, these are things that are going to be playing out over 10, 20 years. So what would you do to an LTV ratio? Reduce it by 0.1 percentage point, and then maybe over a 10-year by 2 percentage. I mean, is this really the way to go? I'm a little bit worried that we're putting a lot of burden on something of a regulatory structure that is maybe more having cost than benefits. Let's put it this way.
Thank you. Paul, what are your views?
Provocative. I have to concur with Stein on this. I think there's the issue that effectively, is it the right instrument for the right purpose? So, you know, you could argue as well, in Tesla cars or electric vehicles are the future, and banks should lend into that with also different LTVs. I think at some stage one has to ask whether that's the role of the macroprudential policy per se in terms of greening the housing stock, or we should focus a little bit more on the actual potential feedbacks from climate to the actual institutions. But I think the other question is, are the banks lending into productive assets? So with downstream emissions intensities, potentially the issue of also interaction with the productive economy. As the macroprudential perspective, you know, all paths always lead to the idea that there's an economic impact. And I think on that front, one would ask, again, the balance between households and firms, I think, is quite important. Much of our attention thus far has been about productive assets that are part of global value chains, might have a large economic impact. So you have this interaction of climate with economic, with financial, and those interactions, those three channels all play together. And on the side of housing as such, I think from an economic standpoint, then it is a bit tricky to know whether you would expect that policy, greening the housing stock or sort of socially desirable outcomes, to maybe fit more with the political wing in terms of the attribution of policy instruments. I think that's the economic standpoint. From a social standpoint, and we had just the previous panel was talking about inequality. I fear, and I think this is again a big topic now when it comes to interacting inequality with climate, that the access to some of the potential technologies which are needed, like solar paneling, wind, harnessing sort of electrical solutions, which are a bit more expensive. And it's one thing that we do know from the climate scientists, is that traditional fossil fuel energy sources are much, much cheaper than their counterparts. So perhaps another vehicle to obtain the same outcome, which would be far more efficient, is to think about a carbon taxation framework, which effectively removes that de facto subsidy you have on fossil fuels. And again, with some redistributive elements, which are inherent to the political wing, could be considered. Whereas I think if you do that in a financial space, it could be a bit broad brush, a bit brute force and unable to also, think about these questions of policies which are redistributive, which lie in a completely different instrument set, which lie outside the hands of the supervisors, even if they should think that that's a sensible thing to do from a financial perspective. So honestly, I have some reservations about borrower-based measures applied to housing in the sphere of climate, asking, wouldn't another policy instrument, perhaps in the fiscal sphere or in the industrial policy sphere, not be more effective in achieving that outcome with fewer collateral side effects?
It's difficult to disagree that we all agree probably that fiscal policy is the primary tool for this particular issue. But nevertheless, as I said, there might be other policies also asked to do their part on their side. On the other hand, so I understand this skepticism and cautiousness. On the other hand, we have to understand that mortgages are a long-term product. And if we are concerned about the resilience, so because this is a long-term credit product, and we're not taking any action, we expect that from macroprudential point of view, banks will look at the geographical location of the collateral, they look probably where the borrowers, which sectors they're working in, and so the action will come from banks themselves, from macroprudential approach. But nevertheless, we could say that maybe we already need we need to direct actually banks already. There is no plan until when, for example, green asset ratio, how quickly green asset ratio in banks how quickly it should develop. But maybe we're not doing their part already. Maybe we should start directing. But on the other hand, as Stein mentioned in his slides, by taking action, we might actually create a risk of a run on brown assets. And banks will stop lending against houses which are not energy efficient anymore, or in certain geographical areas, and there might be big social consequences and other things. So my question would be, there is a trade-off, of course, but if we focus on resilience, maybe already now we should start directing and actually and saying to, in the case of mortgages, because it's a long-term product, that certain geographical areas are at higher risk and maybe should deserve more cautiousness from the lender's perspective as well, and certain energy efficiency, and maybe, but that would be very controversial. I understand if people work in certain economic sectors, so sustainability of their income should be also assessed more cautiously. That's very provocative, but maybe let's start from Stein, please.
No, we keep going back, but just to be sure that the audience is completely with us, the importance of having the proper pricing on carbon emission is key, right? We could really do with a lot of our financial tools at the margin. We can try to allocate and be the central planner that kind of puts the resources in the right way, that we have the green, we don't have the brown. That's a very tricky issue. We've been there before and we haven't succeeded. However, if we set the prices right, the market would do a lot of that work for us. And actually, if the prices are exactly right, it would do everything for us, which is, so you would really have to think here in the second or third best. And then the question of side effects is key. But if you were to push me and saying, well, what should we then do in the housing? Yeah, of course, if the risks are higher in certain areas, the banks or the insurance companies should take action and accordingly provision and what have you, make the mortgages then implicitly more expensive. That's obvious. But of course, we should also be sure that the government isn't subsidizing it with some flood insurance, as happens in some parts of the world, where houses are being built in places where they shouldn't be built in the first place, particularly not with the climate change. So otherwise, you're fighting against a very uphill battle. Could you then still do something? Well, yeah, at least look at the flow versus stock, right? So this goes back to the investment that Paul mentioned. Yes, energy efficient housing, to the extent that people are doing that new, that's great, or to the sense that they're putting in resources to make the houses more efficient. Yes, let's try to encourage that to some extent. But I wouldn't go to the extent to really look at the stock as the main source of the main target of our macroprudential activities here.
Okay, thank you. Paul, please.
You can have promotional lenders. I mean, some of them obviously exist both at the national level, like KfW in Germany, or you have obviously the supranational level ones like the EIB, the EIF, the BRD, could be consider that you lend into greener industries. And in a sense, there's this idea about risk as a function of where we're looking at the prudential framework versus this enabling the transition, which I think lies better with promotional lenders anywhere where you can actually allocate capital in a bit more of a way which is sort of creating the right incentives for that. And again, has a little bit of a political overlay, so one would have to consider where is that most suitable, perhaps not in independent central banks as supervisors. Now, and what is true then, I think, is you have, and Stein touched upon this idea of there are geographies which could be at risk of physical risk hazards, climatological risk, flooding, wildfires, and the like. And obviously, there may be some mechanisms that promotional lenders want to put at play to think about the potential to provide incentives not to expand housing in these areas, which could be subject to such risks, and relocate into other areas. Of course, again, there's a social overlay there, and I think we have to be very conscious of this as financial regulators, whether that would be the right policy for us to enact. I would tend to think of it as it's not necessarily the right place for this as a second or third best, as Stein mentions. I think the one point is about geographies and physical risk. The other is emission intensities. We know housing is quite an emission-intensive part of the economy. And that part does need to be tackled in order to ensure that we get onto Paris-aligned trajectories as economies. And that, again, I think lies arguably still more in the space of the which policy instrument for which purpose discussion. And there I'd say, again, structural policies perhaps are reign central in this respect. Now, what is true, I think, just to round it off, is part of the discussion when it comes to housing will be about the balance of price-based versus quantity-based restrictions. And I think outright bans or outright restrictions in zoning terms is something that may be considered. Again, whether I'd imagine that would still be more on the structural policy planner side. But price-based mechanisms might also be at play. Again, getting back to your borrow-based requirements question, and if you think of a credit surface type of concept, whereby it's permissible leverage that you're allowing is one variable. On the other hand, it's the price of acquiring credit or insuring against that credit is another variable. And I think, and again, on the latter, you could have this idea that I think one of the responding areas, which will be quite crucial in providing that incentive organically, endogenously, will actually be the insurance attached to these types of risks. As the insurance sector is surely going to be tapped more and more, particularly on the physical risk side, to insure houses which are at risk, and to provide either at risk from physical hazards, which is quite clearly obviously associated with their geography, or the transition hazards associated with policy, technology, and sentiment shifts, which again, I think are something which is very real and even near term. So again, it brings me full circle back to where I mentioned in the presentation. I think we need to think really beyond banks on this. It is a system-wide consideration, and insurance will be critical and central, and the interplay that has with the work of banks, not even talking about the broader policy sphere, in ensuring that the transition is an orderly one, and that risks are minimized along that path, which, again, the risk perspective will be the ones that the prudential regulators will have mostly in mind.
Thank you. Let's take one question from the audience. So it's a rather long question, so bear with me. What is your opinion about the approach to mitigate the transition risk for EU financial sector? Would actions at national level be sufficient, or do we need a common tool? So that's the first part of the question. And form of the global perspective, should the EU activate macroprudential policy even without similar global requirements? So maybe let's start from Stein again. Stein, please.
Now, clearly, this is a global challenge. So to the extent we can achieve global standards that are consistent with our overall goals, because it has to be the orderly transition that we're aiming for, obviously we'll be all for it. And there's a lot of work underway, building on what's happening actually in the EU often, because the EU is often ahead in terms of standards, taxonomies, and also mandating those more consistently from the private sector. So I think we have potential for that. It's not easy, so we should not be naive here. We'll get to see what happens in COP26 when there's some further debate on that. These things also move relatively slow in terms of coordination. This is always a challenging task. So. But I would say on the private sector side, where in many ways the market is running ahead, there's a little bit more scope to help more. And even the private sector is trying to coordinate among itself, but it's a big task, of course. So here I think we can put our heads together more collectively and more astutely to achieve that. And here the granularity from what we're trying to achieve is not easy, right? So when I say standards and taxonomies, we both have to, and I mentioned that we have to think of project activities, firms and countries. We have to think of emissions, risks. We have to think of plans. So there's a big task there in terms of making that such that together with the supporting institutions, we achieve that. But I think that is where I would put a lot of my effort, because the desire is there in the private sector, the amount of money that are committed now to this area. And here we think really outside of banks, right? Because banks is in some sense just a short part of the puzzle. It's not long-term financing in the first place. Much of financing has gone to the non-banks. Once we get all of these investors to sign up for something that's doable and consistent, we can make a progress here that's not small. We at the BS are trying to do that. NGFS is we're a member of that, together with other central banks, of course. So hopefully we'll be able to find something that's workable in the near future.
Paul, please.
Tended to have the view that this coordinated approach is the best one to tackle what is clearly a systemic problem of engineering an orderly transition. So here, to the questions that being asked about national level versus sort of cross-jurisdiction initiatives, I'd argue the latter is a clear case for policy coordination. If there ever were a clear case for the benefits of a coordinated approach, this is it. Now, I think the difficulty that also is the overlay on this is not just about the benefits of collective action to generate orderly transitions insofar as the financials are concerned, but also this dual materiality notion. So keep in mind when it comes to global emissions, Europe as a collective whole, the European Union, is only north of 2 digits, so 10% of global emissions. Whereas if you look at emerging Asia, it's including China, it's around half of global emissions. So clearly thinking about our emerging markets as a general collective whole, we're also industrializing rapidly and we'll have more energy needs. And those energy needs will obviously be fossil fuel dependent partly. So any action to tackle the climate angles, again with this dual materiality of lending into the climate risks, which have endogenous feedbacks under financial risk, one would have to think about the benefits of collective action, suggesting that you could, in theory, then solve two issues which are basically bundled, but I think you could separate, which is informational inefficiencies are key here. And the disclosures, just transparency, sunlight as a disinfectant, I think is key. The disclosures, the standards attached to those and the validation of those disclosures, and the ability to aggregate information, so the standardization of all of this, are key. And this is the work of the NGFS, the work of the FSB, and the work of other prominent bodies in the international sphere is looking exactly at this internationally. But more locally, I think what's important, and I gather the question may come from one of your European participants, is within the EU, of course, we have even more tightly knit cooperative arrangement. And within this arrangement, I think you can make a key difference in devising, say, a sort of sandbox and ability to test and try out measures in a way which is consistently applied across national jurisdictions. And insofar as that's the case, I think if you cannot cooperate in the EU in this tightly knit arrangement, one fails to see basically how the incentives are any better when you move into the broader international sphere. So I think we can also set the standard in the EU by ensuring that you have this level playing field, the ability to actually have common standards applied, be it in terms of disclosures, data, but through to the prudential framework. And we are actively redoing this at the moment. So with that in mind, I think it's clear that you have this element of benefits of collaboration, cooperation. Now, I think Stein alluded to, and it's an important point, is absent public policy measures, which I think have been a bit lagging in the international sphere the last, say, since Paris Agreement signing for a variety of reasons, is that the private sector is taking off with a variety of initiatives. The difficulty, I think, with a fragmented approach, or one where you actually have a proliferation of micro initiatives, is that the consistency between them is at best weak. And I think this is the problem we're now currently facing, is that a proliferation of initiatives to tackle this issue, a big global issue with micro elements or incomplete information, is implying that you have some market distortions, I think, which are inhibiting the potential that this could have to actually contribute to an orderly adjustment. And insofar as that's the case, again, I think it's another point that the public sector collectively, I think, can make a big difference in setting up the standards, the approach, and having this cross-sectionally, sort of jurisdictionally equivalent method across jurisdictions. And we are seeing this. The NGFS has an enormous number of members, so northward of 80 jurisdictions at the moment. The Basel Committee, the FSB have now picked up on this, the G20 level as well. And of course, insofar as this is the case, I think we already have the mechanisms in place. There's now just a chance to make it work. Again, in the absence of, and with the lags that are occurring with respect to that global solution coming online, national initiatives might be sandboxed, but considered in that context, because I think we're going to learn from best practices as we move along in this sphere.
Thank you. Indeed, this is a global issue, and solutions and actions ideally should also be at global level, and data is very important. So time is up. So I have to say, unfortunately, we haven't come up with ways how macroprudential policy could help to sort out this very important issue, but it's not the last time we're talking about these issues, I'm for sure. Over time, things might change, our views might evolve as well, and we might come up with issues how to help to stop climate change. So thank you to both speakers. Thank you for great presentations and great participation. Thank you. Yeah.
Thank you. Thank you very much.
Back to Agni.
Thank you very much, Thomas. Thank you very much, panelists. I also want to express huge gratefulness for the previous panelists, previous speakers. It was great opportunity to host you here in Vilnius, at least virtually. And this conference also proved to be a very good opportunity to discuss borrower-based measures from different angles, and we strongly believe that this topic will stay relevant in the years to come. I also want to express a huge gratefulness for our viewers who are watching this conference. I also would like to remind you that you're still able to leave your opinion and your comment about this conference in the comment box, in the top bar of the comment box. Please do so. Your opinion is extremely valuable to us. And let me now conclude the conference. And I want to wish you all well, stay healthy, and I also want to take this opportunity to invite you to the next Macroprudential Policy Conference organized by the Bank of Lithuania. That will be hopefully organized in 2023, and we hope by then we'll be able to host you in our beautiful Vilnius. So thank you and goodbye.